Ind AS 21, the effects of changes in foreign exchange rates. The title will immediately remind you of Accounting Standard 11, isn't it? The Accounting Standard 11, the one that you have done at the earlier level. The title of AS 11 is also the effects of changes in foreign exchange rates. It is not necessary that an entity which is based in India will do transactions only in Indian rupees. Not necessary. For the purpose of manufacturing your final product, you may be importing certain raw materials. Now, when you are importing, you will be importing in foreign currency. Whatever you are manufacturing in India, not necessary that you will be selling only in India. You may also be selling outside India. You may be carrying out exports. These exports will be initially measured in foreign currency. Similarly, you may acquire assets in a foreign country. Likewise, you may raise liabilities in a foreign country. These are different instances where you may have assets, liabilities, you may have income, expenses which are in foreign currency. How are these transactions to be accounted for in our books? That is basically the scope of Ind AS 21. Let us understand what are the different transactions that will get covered by Ind AS 21. They are saying in accounting for transactions and balances in foreign currencies. Isn't it? Any transaction which is in foreign currency, if you are having any balances in foreign currency, for example, you have exported, you are receiving some money in foreign currency that is lying outside India in some bank account. You may acquire assets, those assets are lying outside India. The balances of those assets will be in foreign currency. You may have raised liabilities and other obligations in foreign currencies. They also have balances as on the balance sheet date. What to do with those balances? They are saying in accounting for transactions and balances in foreign currencies, except there are certain items which are not covered here. They are saying except for derivative transactions and balances covered by Ind AS 109. Derivatives is covered by Ind AS 109. Hence, over there I will not apply Ind AS 21. Foreign currency derivatives not covered by Ind AS 109 are within the scope of this standard. If there are any foreign currency derivatives to which Ind AS 109 is not applicable, we will apply Ind AS 21. The standard also applies for translation of amounts relating to derivatives from functional currency to presentation currency. Ind AS 21 brings out a new concept of functional currency. We will be seeing that as we will move ahead in this particular Ind AS. Any translation that you have to do from functional currency to presentation currency with respect to the derivatives, that will also be a subject matter of Ind AS 21. Okay. It's also possible that you may have a foreign operation. For example, you are an India-based entity, but you have a branch outside India, or a subsidiary, or an associate, or a joint venture outside India. This foreign operation will be maintaining its books in foreign currency. These foreign currency amounts will be required to be converted into the currency of the presentation of the reporting entity. This work will be also done as per the principles of Ind AS 21. In translating the results and financial position of foreign operations that are included in the financial statements of the entity by consolidation, proportionate consolidation, or the equity method. When you say I will follow consolidation, that means your foreign operation is a subsidiary. When you say proportionate consolidation, that means it is turning out to be a joint operations, right? And when you are saying equity method, that means it is a case of associate or it is a joint venture, right? In order to carry out the translation of a foreign operation, which may be in a form of a subsidiary, a joint operations, an associate, or a joint venture, or it can even be a simple branch, you have to apply Ind AS 21. And finally, in translating an entity's results and financial position into a presentation currency. Let us say I am not having a foreign operation, but I do have different transactions in foreign currencies. Ultimately, when I will prepare my financial statements, everything should be in a presentation currency. At that time, if any translation is required to be done, the principles that will be applied for the purpose of translation shall be the principles of Ind AS 21. Yes, there are certain items which are outside the scope of Ind AS 21. The reason why they are outside the scope of Ind AS 21 is because some other Ind AS is applicable over there. Yes, the first one is with respect to hedge accounting. If you are using any derivative based product or you are using any other item for the purpose of hedging, but that item is going to be expressed in foreign currency, but since it is a part of the hedge accounting, Ind AS 21 will not be applicable. You'll have to apply the principles of Ind AS 109. They say hedge accounting for foreign currency items, including the hedging of a net investment in a foreign operation. The above is covered by Ind AS 109. Similarly, the effects of the foreign exchange rates may also affect your cash flows, but cash flow accounting, or the presentation of cash flow accounting rather, I'll say, will be covered by Ind AS 7. Presentation of cash flows from transactions in a foreign currency or to transactions of cash flows of foreign operation in the statement of cash flows will be covered by Ind AS 7. And finally, when you are applying Ind AS 101, now 101 is with respect to first time adoption of Ind AS. It is quite possible that you are following regular accounting standards right now, and now you have to move towards the Ind AS. When you are moving towards the Ind AS for the first time, you have to apply Ind AS 101. The title of Ind AS 101 is the first time adoption of the Indian accounting standards. Now, in accounting standard 11, for long-term foreign currency items, a very specific, a very typical option is given. Now, when you are moving towards the Ind AS 101 is giving you an option. Either you continue following the typical option given in AS 11, or you discontinue that system and start following Ind AS 21. For example, AS 11, if you are very much aware about AS 11, I'll just give you the glimpse of what that item is. There are certain long-term foreign currency monetary items. Okay, long-term foreign currency monetary items. AS 11 says that whatever is the fluctuation gain or loss for these items, it should be transferred to a monetary item translation difference account. Okay, instead of taking it to the profit and loss account, you will take it to a separate reserve. Now, this is an option which is given in AS 11. No such thing is there in Ind AS 21. But when you are applying Ind AS 21 for the first time, that is when you are moving from accounting standard 11 to Ind AS 21, you have to also first follow Ind AS 101, which is first time adoption of the Ind AS. In first time adoption of Ind AS, that is in Ind AS 101, they are suggesting that if you want to continue with the option which is given in AS 11, you can continue to do so, right? If any entity at the time of moving towards the Ind AS for the first time is exercising this particular option, then this item will be treated as per accounting standard 11 and will not be treated as per Ind AS 21. And that is the reason it will become, or rather I'll say it will go outside the scope of Ind AS 21. They say long-term foreign currency items for which an entity has opted for the exemption as per Ind AS 101, such an entity may continue to apply the accounting policy as opted for such long-term foreign currency monetary items. So this basically spells out what is the scope, that is what is within the scope of Ind AS 21 and what is outside the scope of Ind AS 21. Ind AS 21 recognizes three types of currencies: foreign currency, functional currency, and presentation currency. Out of all these three, functional currency is a brand new idea which is introduced by Ind AS 21. The rest two currencies we are more or less comfortable because we have already done at the earlier level accounting standard 11. In AS 11, we do make use of foreign currency. Without foreign currency, I don't have to do AS 11. AS 11 is all about effects of changes in foreign exchange rates. Foreign currency is definitely a concept there in AS 11. And in AS 11, we have a concept of reporting currency, which is nothing but the presentation currency, right? The term used in Ind AS 21 is not reporting currency, but presentation currency. Functional currency is something which is missing in our accounting standard 11. Hence, in order to understand Ind AS 21, it is absolutely a must that we understand the concept of functional currency. As I said, functional currency is something which is not there in AS 11. It's a brand new concept introduced by Ind AS 21. Okay, let me explain you with giving an example that why do we need this concept of functional currency. I will tell you one thing. Functional currency can make life of certain companies very easy. Something which will not be there if they were following accounting standard 11. Think in this way. I am an entity based in India. Now, the moment I say that I am based in India, you will say you have to maintain your books in Indian rupees. Isn't it? I am based in India. And because of that, you will immediately tell me that, see, your company is based in India, maintain your books in INR. But the way I am conducting my business, whatever I am manufacturing, for that around 80 to 90% has to be imported. The raw material which I require has to be imported. And I'm importing that in US dollar. Now, because you are saying that I have to maintain my books in Indian rupees, every time when I import raw material, the invoices which are in dollars need to be converted into INR. Similarly, whatever I am manufacturing in India, 80 to 90% of that is exported by me. Okay, whenever I am exporting, I am raising the invoices in dollar. Again, you will immediately tell me that, see, you are an Indian company. You have to maintain your books in INR. Hence, whenever you are exporting, the dollar invoices have to be converted into INR. So just see, throughout the month, there are multiple transactions of imports. Every time I have to convert the dollars into INR. Throughout the month, or rather I'll say throughout the year, I'm exporting, because that is what my business model is. I import raw material, manufacture in India, and then I'm exporting. My invoices of imports are in dollars. My invoices of exports are in dollars. Whenever I import, whenever I export, every time I have to find out what is the exchange rate right now, convert the dollar figures into INR, because you are telling me that since you are an Indian company, since you are headquartered in India, you have to maintain your books in INR. And you know what? Whenever there is a budget, when the Indian government is presenting a budget, I am not much affected by it. I am not much affected by it. But when the US government is making certain policy changes, then that is affecting my business. Whatever I am exporting, around 60% of the goods manufactured by me are exported to the United States. If the US government is making any policy change which will aid, which is in favor of the US companies, then it will go against me. Any US policy which is encouraging imports from India, it is actually benefiting me. It is the policies of the US government which is affecting me more rather than anything else. Any custom duty change in US, it will affect my selling price. You get it? So Indian policies are not affecting me. It is the US policies which are affecting me. My cash flows are more or less maintained in US dollars. The reason is that I have to make payments in US dollars. Whatever I'm importing, most of it I'm importing, and I have to make payments in US dollars. So whatever are my export proceeds, I'm maintaining that in US dollar, and then I'm making the payments. But because there is no concept of functional currency, I have to convert everything that I'm doing in USD. Each time I have to convert that into INR. You can understand how difficult my life is going to be, or the life of the accountant. Let's say how difficult the life of the accountant will be. Every import in dollar, convert to INR. Every export in dollar, convert it to INR. Every time you are doing a transaction, the latest exchange rate has to be identified, and accordingly the accounting is needed to be done. This is what will happen in the absence of concept of a functional currency. This is what will happen to those companies which are following accounting standard 11, because in AS 11 we don't have any such concept. But life of mine will be much simpler under Ind AS 21, because Ind AS 21 has a concept of a functional currency, which they say it is the currency of the primary economic environment in which the entity operates. Understand? I'm importing in dollars, I'm exporting in dollars. 80 to 90% of my expenses, maybe even more than that of my revenue, is all in US dollar. It is the competitive forces of the US which is affecting my selling price, affecting my profits. I can say that the primary economic environment of mine, although I am based in India, the primary economic environment is that of the US. And that is the reason I can consider US dollar as the functional currency. You may argue that how will this make life simple? I will maintain books in US dollar and hence my life will become simple. Earlier, whenever I was importing in dollars, I had to convert that into INR. Earlier, whenever I was exporting, I had to convert it into INR. Now I will not do any such thing. The moment I say that US dollar is my functional currency, what will happen? I will maintain my books in dollar. Imports which are in dollar will remain in dollar. Exports which are in dollar, I have to simply do the accounting in dollars. Getting it? And that is what is making things much, much simpler for me. A currency other than the functional currency will be understood as a foreign currency. Okay, this will be the foreign currency. They say a currency other than the functional currency of the entity. I am an India-based company. I have decided that US dollar is my functional currency. I am paying salary to my employees in INR. Remember, I am paying the salary in INR. I am an India-based company, but the salary that I will pay in INR will be considered to be a foreign currency because my functional currency is US dollar. Any currency other than the functional currency will be understood as a foreign currency. Hence, if I am maintaining my books in dollar and I am making a payment in INR, then this INR has to be converted into USD. However, finally, when I am presenting my financial statements before my shareholders, ultimately I want to present it in INR. I am an India-based company. I am listed in India. I have to send a copy of my annual report to my Indian shareholders. Now, sending them an annual report in USD perhaps will not make sense. Hence, I may finally convert my USD to INR. That is what will become the presentation currency. They say the currency in which the financial statements are presented. So there can be entities which are having functional and presentation currency is the same, or there can be entities where the functional currency and presentation currency can be different. Understand? I am an Indian company. I am doing my analysis. I realize that my functional currency is INR. Hence, any currency other than INR will become foreign currency. But because I am an India-based company, I am maintaining my books in INR, and hence I will also present my financial statements in INR. Functional currency INR, presentation currency also INR. So this is an example of an entity which has functional currency and presentation currency as the same. But as we had taken the earlier example, I am an India-based company. I come to the conclusion that USD is my functional currency. Any currency other than USD is foreign currency. Books will be maintained in functional currency, but the ultimate presentation has to be done to the Indian shareholders. I feel that Indian shareholders will not be comfortable with financial statements prepared in dollars. Hence, books which I have maintained in dollars will be translated to INR. This time my functional and presentation currency are different. Functional currency USD, any currency other than USD is foreign currency, and ultimate financial statements will be presented in INR, and hence INR is the presentation currency. Of course, the main question that arises now is, how are we going to identify what is our functional currency? Yes. Let's understand the factors to be considered for determining an entity's functional currency. These factors are segregated into two categories: primary indicators, secondary indicators. Remember, more importance should be given to primary indicators. If by evaluating the primary indicators itself it has become clear that so-and-so currency is your functional currency, then do not attach much importance to the secondary indicators. Many a times the primary indicators, when you do analysis on the basis of primary indicators, you may get a mixed view, right? You may get a feeling that INR is functional currency or maybe even USD. You may be a bit confused between the two. That's the time where secondary indicators can also be taken into consideration. Let's understand the primary indicators. They are saying the primary indicators, the first one, or we may say A, it is the currency that mainly influences the sale price for goods and services. This will often be the currency in which the sale prices for its goods and services are denominated and settled. And, okay, the second thing also simultaneous should happen. Of the country whose competitive forces and regulations mainly determine the sale price of the goods and services. We should simply extend over here our earlier illustration. Whatever I was importing, around 70-80% of that I'm importing in US dollar. Whatever I am selling outside India, the sales are denominated in US dollar. So what has happened is most of my expenses are in dollars, most of my revenue is in dollar. And then it is the US policies which are affecting me more, right? So that's the reason I can say that the country whose competitive forces and regulations are determining the selling price, it's turning out to be the US dollar over here. So we are asking over here, which is the currency which is influencing your selling price for goods and services. We come to the conclusion it is USD. Competitive forces of USA is affecting me more, right? And then I apply B. The currency that mainly influences labor, material, and other costs of providing the goods or services. This will often be the currency in which such costs are denominated and settled. However, the labor that I'm employing is in India, right? It's quite possible that the labor expenses are being met in the Indian rupee. As I said, we are giving importance to the primary factors. Both of them need to be considered. Many a times you'll get a clear indication or you may get a mixed indication. If you get a clear indication, really good. If you get a mixed indication, then there are also secondary indicators that need to be taken up. In our illustration, our selling price is denominated in INR. In our illustration, the regulations of US is affecting you more. However, in our illustration, when we are manufacturing in India, we are employing laborers in India. To them, we are making payment in wages in INR. We also have administrative staff. To them, we are making payments in INR. However, the material and other costs that I said we are importing, and that is in USD. Just look at the primary indicators. Don't you feel that USD is turning out to be the functional currency over here? You can see most of it is USD, although a few transactions here and there are also in INR, isn't it? Hence, in our illustration, based on primary indicators, one can argue that US dollar is the functional currency. The moment you say US dollar is the functional currency, one can say that the books will be maintained in USD. And the moment you will do it that USD, understand, INR will become a foreign currency. I'll have to maintain all my transactions in US dollar. But let us say we are not importing from outside India. The raw material is indigenously available. Hence, this material cost is actually in INR. Your selling price is in USD. The competitive forces of US is definitely affecting you more, agreed. But when it comes to expenses, when it comes to material, goods and services, all these things are in INR. I'm getting a slightly mixed view over here. The primary indicators are not giving me a clear indication of what the functional currency is going to be. Okay, then I have certain secondary indicators. I'll consider the secondary indicators, and on the basis of that, I will again try to work out what can be the functional currency. Okay. The currency in which funds from financing activities, that is issuing debt and equity, are generated. You are saying it's an Indian-based company. You are saying I'm importing outside India. You are saying I'm exporting outside India. Fine. But when you are importing, you will have to make payments. How are you settling your obligation? In which currency are you settling the obligation? So that is what I have to check over here. In order to do business in India, I have borrowed money from Indian banks. Okay. In other words, the secondary indicator is that the currency in which funds from financing activities are generated is INR. And B, they are saying the currency in which the receipts from operating activities are usually retained. You may be exporting outside India. You may be receiving payments in dollars, but ultimately you are holding the receipt in which currency? It's quite possible that the moment my clients are making payments in dollars, I'm immediately bringing that money in India and converting that into INR. For a simple reason, I have borrowed in Indian rupees, so I have to repay those loans. And to repay those loans, I require Indian rupees. Agreed, I am exporting outside India. Majority of my exports is to US. My receipts are in US dollar, but I do not leave my receipts in dollar. I repatriate that money. I bring that money back to India and convert that into INR. Now, as you can see, primary indicators was giving us a mixed view whether it is USD or INR. Hence, primary indicators were not clearly suggesting that what shall be the functional currency. But now when I take the secondary indicators, I realize that more or less it is the Indian rupee. Hence, my functional currency will turn out to be INR. If you say my functional currency is INR, then whatever you are importing in USD, whatever you are exporting USD, USD is other than INR. A currency other than the functional currency will be a foreign currency. So in this particular situation, USD shall become, USD shall become the foreign currency and INR shall become the functional currency. However, it is still possible over here that the funds that you have raised in USD. As you can see, 80 to 90% of your sales is happening in US itself. You have your own you have built your own reputation in USD. Companies in USD are recognizing you as a company which is doing good business in US. You are having banking relations in US, and because of that you are able to borrow in US dollar. If you are able to borrow in US dollar, then the currency in which funds from financing activities are generated is turning out to be USD. Whatever I am exporting in US dollar, and once my clients are making payments, I am retaining that money in USD. Very simple. I have borrowed money in US. I have to make repayment of that in US dollar. And hence my operating activities which are giving me cash flows in US dollar, I am leaving it in US dollar, because of which I am able to repay my borrowings. Needless to say, over here it is the USD which will become the functional currency. Any currency other than USD shall become the foreign currency. You need to apply the primary indicators and the secondary indicators, but remember, more importance has to be given to the primary indicators, and on the basis of that you will decide your functional currency. Over a period of time, there can be a change in the functional currency. Yes, it's very much possible. Today, whatever you are manufacturing in India, you are more or less exporting it. But 5 years down the line, it is quite possible that your product has become extremely popular even in India. You are still exporting, but now exports is only 10 to 15% of your total sales, unlike what it was in the earlier years. In such a situation, there can be a change in functional currency. Remember, change in functional currency effect has to be given prospectively. Do not disturb what you have already done in the past. When there is a change in an entity's functional currency, the entity shall apply the translation procedures applicable to the new functional currency prospectively from the date of the change. Now, it's also very much possible that you may have a foreign operation. Let us say you are an India-based company, and you have done all your analysis, and for you, the functional currency is turning out to be INR. Let's put it in that way. You are having a functional currency of INR, but you are having a foreign branch, or you have a foreign subsidiary, or a foreign associate, or a foreign joint arrangement. These are nothing but foreign operations. Your functional currency is INR. It is not necessary that the functional currency of the foreign operation shall also be the same as the reporting entity. It can be different. And that's where certain additional factors is given in Ind AS 21. I'm talking about a situation, something like this. Let us say we have a company A Limited, and A Limited has a subsidiary in USA, let's say. We are talking about the functional currency over here. Functional currency. Let us say the functional currency of A Limited is INR. Okay. Question is, what is the functional currency of this foreign operation? The subsidiary in the USA, I will consider this as a foreign operation. What shall be its functional currency? Someone can argue that A Limited, which is the parent company, its functional currency is INR. Hence, obviously, the subsidiary in USA, its functional currency should also be INR. We are making an assumption over here that whatever is the functional currency of the reporting entity, the same shall be the functional currency of the foreign operation. But it is not necessary that it will be like that. It's quite possible that because the subsidiary is in USA, its functional currency may turn out to be USD. Is the functional currency of the foreign operation USD, or is it the same as the reporting entity? Ind AS 21 has given certain additional factors to be considered. Of course, more importance has to be given to the primary indicators only. After that, the secondary indicators. But if still there is a little bit of confusion, then additional factors are also given. Additional factors to be considered for determining the functional currency of foreign operation. See, foreign operation has been defined as an entity that is a subsidiary, associate, joint venture, or a branch of a reporting entity, the activities of which are based or conducted in a country or currency other than those of the reporting entity. Reporting entity in our example is based in India. Its functional currency is INR. You have a foreign operation which is doing transactions in a currency other than INR. It's very natural. If I have a branch outside India or a subsidiary outside India, or for that matter an associate or joint venture outside India, obviously the moment it is based outside India, its transactions will be in a currency other than INR. In addition to primary and secondary indicators, additional factors set out in Ind AS 21 should be considered to determine whether functional currency of foreign operation is the same as that of the reporting entity. Right, that's the question that we are asking ourselves. Reporting entity's functional currency is INR. Can I just assume that the functional currency of the foreign operation will also be INR? Okay. Additional factors. Let's understand. Whether the activities of foreign operations are carried out as an extension of the reporting entity rather than being carried out with a significant degree of autonomy. You are saying I have a subsidiary in US. Fine. Can the subsidiary take decisions independently, or is the subsidiary dependent upon the Indian parent for its day-to-day management? Right, so we have to figure out, have we given a certain level of degree of autonomy to the foreign subsidiary? Right, for example, the foreign subsidiary has its own independent board. The day-to-day management will be done by that independent board. Yes, when major decisions are to be taken, for example, the subsidiary wants to raise a huge amount of money by issuing some bonds or debentures, or the subsidiary is planning to come up with a public issue of shares, or the subsidiary is deciding to merge itself with some another entity, the subsidiary is planning to acquire some another entity. Yes, at that time the parent will step in, but day-to-day management will be done independently by the board of directors of the subsidiary. Have you granted such kind of autonomy, or everything is remote controlled from India? You get my point? So that is the question that we should ask ourselves over here. Okay. Whether the transactions with the reporting entity are a high or a low proportion of foreign operations activities. The only reason why I have floated a subsidiary in US is so that it can import what I am manufacturing in India. Okay, manufacturing is done in India and then I have to export that to US. Instead of exporting it directly, I have floated a subsidiary in US. This subsidiary in US is working only as a front. Okay, subsidiary has nothing else to do. Subsidiary will be basically importing whatever I have manufactured in India. In other words, it is nothing but an entity with whom I am having a huge number of transactions. The subsidiary itself is not doing any manufacturing. All the manufacturing is done in India. All that the subsidiary does is the subsidiary is importing what I have manufactured in India and then it is selling in the US. Because it has to import from the Indian parent, there will be large number of transactions. Basically, the subsidiary is dependent upon the Indian parent. Okay. Whether cash flows from the activities of the foreign operations directly affect the cash flows of the reporting entity and are readily available for remittance to it. I am manufacturing in India. My foreign subsidiary is importing it and then selling it in US. The cash flows of my foreign operation obviously is affecting my cash flows. And these cash flows which are there in the foreign currency will be immediately brought to India. So that is C over here. And finally D, whether cash flows from the activities of the foreign operation are sufficient to service existing and normally expected debt obligations without funds being made available by the reporting entity. The foreign operation has an independent market for its own products. The foreign operation has its independent sources of cash flows. Because it has independent source of cash flow, it can independently repay its obligations. Is it so? Or is it dependent upon the Indian reporting entity for the same? These are the questions that we should really ask ourselves. Okay, question number 1. Again, very quickly, and then let's try to understand what will be the end conclusion. Question number 1, or the factor number 1, right? The first factor is the foreign operation simply an extension of the Indian arm? You know, I can directly export to US, but instead of directly exporting US, I'm exporting it through a branch, through a subsidiary, or through an associate, or through a joint venture. Okay, it is just an extension of the activities which I am doing. If your answer is yes, please consider that the foreign operation and the Indian arm or the reporting entity, their functional currencies are the same. However, there is a degree of autonomy that I have granted to my foreign operation. I am telling my foreign operation that whatever is the day-to-day management, you take independent decisions. Okay, here there is a possibility that the functional currency of the foreign operation may be different from the functional currency of the reporting entity. Second, there are large transactions between the foreign operation and the reporting entity. In such a situation, the functional currency of the reporting entity and the foreign operation shall be the same. Okay, let's say there are very few transactions. The foreign operation has its own manufacturing plant in the foreign country. It is itself independently manufacturing that product, and once manufactured, it is selling that in US. It does not have to import what I am manufacturing in India. It has a separate manufacturing facility. It is able to manufacture in US, and after manufacturing in US, it is selling in US. There are very few transactions between the reporting entity and the foreign operation. Very much possible that the foreign operation has a functional currency different than that of the reporting entity. Okay, the foreign operation has its own independent market, and because it has its own independent market, it has its own independent source of cash flows. These cash flows are not brought back to India. Is it so? Then it's quite possible that the functional currency of the foreign operation and that of the reporting entity is different. And finally, because the foreign operation has autonomy, because the foreign operation has its own independent source of cash flows, because the foreign operation has an independent market for the products that it is manufacturing, that particular foreign operation also has the necessary financial resources to repay its loans. It has necessary financial resources to pay its obligations. If this is so, quite possible that the functional currency of the foreign operation and the reporting entity are different. Getting it? If you come to the conclusion that the foreign operation is an extension of the Indian arm, large number of transactions between foreign operation and the reporting entity. Foreign operation is dependent upon the reporting entity for its cash flow requirements. Foreign operation does not have necessary autonomy, but it is dependent upon the reporting entity for the payment of its obligations, for the repayment of its borrowings. Consider this to be a foreign operation whose functional currency is the same as that of the reporting entity. Suggest treatment based on Ind AS 21. Future Limited sells a revitalizing energy drink that is sold throughout the world. It seems that we are exporting it in different countries. Sales of the energy drink comprise over 90% of the revenue of Future Limited. 90% of your revenue is because of exports. For convenience and consistency in pricing, sales of the energy drink are denominated in US dollar. 90% of your revenue is because of the sale of the energy drink, and the energy drink is priced in US dollar. Indirectly, it means 90% of your revenue will be in US dollar. But important is this particular phrase. They are saying for convenience and consistency in pricing. It is not that the competitive forces of US is making you price the energy drink in US dollar. No, I'm exporting to US, I'm exporting to European countries, African countries, and maybe a lot many other destinations. In order to bring about convenience, I am pricing everywhere in US dollar. Fine. Then they say all financing activities of the Future Limited are in its local currency, L dollar. Although the company holds some USD cash reserves, almost all of the costs incurred by Future Limited are denominated in L dollar. What is the functional currency of Future Limited? I want to decide the functional currency of Future Limited. In order to decide the functional currency, there are certain primary indicators. And if it is not clear on the basis of primary indicators, we also have some secondary indicators. Okay. In this particular case, let us try to analyze it on the basis of primary indicators. They are saying the currency that mainly influences the sale prices for goods and services. They are saying this is often the currency in which sales of prices for its goods and services are denominated and settled. In our example, it is turning out to be the USD. Then they say the currency of the country whose competitive forces and regulations mainly determine the sale price of goods and services. We have made it very clear in this particular case that we are pricing our energy drink in US dollar not because the competitive forces of US is affecting us. No, only for convenience, only for the purpose of consistency. Hence here I cannot say it is the USD. Okay, so USD only the first part will get covered. Then they say the currency that mainly influences labor, material and other costs of providing goods or services. Here it is turning out to be the local currency, L dollar. Now if I look at the primary indicator, it is giving me confusing signs. On one hand I have USD, on the other hand I have L dollar. I am not able to decide on the basis of primary indicators. Okay, let us now consider the secondary indicators. Okay. The currency in which funds from financing activities issuing debt and equity are generated. And they say the currency in which receipts from operating activities are usually retained. Let me go back to the case. They are saying all financing activities of Future Limited are in its local currency, right? So here I will say it is L dollar. Okay. Then they are saying almost all of the costs incurred by Future Limited are denominated in all dollar. Okay, here, sorry, this one. Although the company holds some USD cash reserves, currency in which receipts from operating activities are usually retained is also L dollar. Although you have some cash reserves in USD as well. L dollar here, L dollar here, and in primary indicators also at one place L dollar. The functional currency, of course, is L dollar. Functional currency is L dollar. Let's read the response. The functional currency of Future Limited is L dollar. Looking at the primary indicators, the facts presented indicate that the currency that mainly influences the cost of producing the energy drink is L dollar. As stated in the fact pattern, pricing of the product in USD is done for convenience and consistency purpose. There is no indication that the sales price is influenced by the US dollar. Small India Private Limited, a subsidiary of Big Incorporation, takes orders from Indian customers for Big Incorporation's merchandise and then bills and collects for the sale of the merchandise in rupees. Okay. You have Big Incorporation. It has a subsidiary which is Small India Private Limited. Okay. We are given a foreign operation this time. They are saying that Small Incorporation is taking orders from Indian customers for Big Incorporation merchandise and then bills and collects for the sale of the merchandise in rupees. Bills and collects in INR. Okay. Small also has a local warehouse in India to facilitate timely delivery and ensure that it remits to its parent all the cash flows that it generates, as the operations of Small are primarily financed by Big Incorporation. Whatever are the cash flows that will ultimately go to Big Incorporation. Big Incorporation is based in US and has its functional currency as US dollar. Big Incorporation's currency is USD. They are saying, what is the Small's functional currency? Okay. Big Incorporation is a US based company. It has a subsidiary in India. Now the question that will arise over here is that subsidiary is a foreign operation. Will the functional currency of the foreign operation be same as that of the reporting entity, or can it be different? Here we have to give importance not just to the primary indicators and secondary indicators, but also to the additional factors. Right, certain additional factors are to be considered. Look at the additional factors and try to analyze that in the given case. Okay, they are saying whether the activities, the first one, okay, whether the activities of the foreign operations are carried out as an extension of the reporting entity or with an autonomy. See, Big Incorporation could have always directly exported to US, but instead of doing a direct export, it has floated a subsidiary in India, right? So what has happened over here is that whatever was the exports that Big Incorporation could have done directly, instead of doing it directly, it is doing it through a foreign operation. In other words, it doesn't seem that the subsidiary of the foreign operation is enjoying much autonomy, right? Whatever are the transactions which are being carried out, they are carried out within the direction of the main parent company. Then they are saying whether the transactions with the reporting entity are a high or a low proportion of the entity's foreign operations. Now, it doesn't seem that Small company which is based in India is having much degree of autonomy. All that it is doing is it is booking orders on behalf of the merchandise of Big Incorporation. And then once the orders have been received, it will be importing from the Big Incorporation and then selling it in India. Naturally, there will be a large number of transactions between the US parent and its Indian subsidiary. And it is very clearly given in the case that whatever cash flows are there of the foreign operation, they are ultimately getting transferred to, right? They are getting readily available. They are basically getting remitted to the Big Incorporation, isn't it? Keeping all these factors in mind, it seems that the foreign operation and the reporting entity, which is the Big Incorporation, their functional currency will be the same. Since it is very clearly given that Big Incorporation's functional currency is USD, for Small also the functional currency will turn out to be USD. Small, although based in India with its cash flows generated in India, is essentially a pass-through company established by its parent. Getting it? Pass-through company means you want to sell to Indian customers. Big incorporation can directly sell to the Indian customers. But instead of directly selling, it has created one layer in form of small company, Small India Private Limited. Getting it? So Small India Private Limited is only working as a front. That's it. Otherwise the transactions, right? Otherwise the transactions are being directly done with big incorporation only. That is the reason we say it is simply but a pass-through company. Small is totally reliant on big incorporation for financing and goods to be sold, despite the fact that goods are sold within India and in INR. You are selling in INR, but are you manufacturing those goods? No, you are not manufacturing those goods. Ultimately, the goods will be manufactured by big incorporation only. That means you are reliant, you are dependent on big incorporation. Small is not a self-contained entity in India, rather than an entity dependent on its parent. Thus, it can be said that the primary economic environment small is that of US, and thus its functional currency should also be US dollar. In short, the functional currency of the reporting entity and the foreign operation both are the same. A is an Oman-based company having a foreign operation B in India. Okay, A has a foreign operation B. A is based in Oman, B is based in India. The foreign operation was primarily set up to execute a construction project in India. B will execute construction project. I'm not writing in India because B is based in India, hence it will execute a construction project in India. The functional currency of A is OMR. Functional currency of A is OMR, that is the Omani Riyal. Okay, obviously the question will be, now since the functional currency of A is already given, naturally the question will be, what is the functional currency of the India-based foreign operation? Okay, they say the functional currency of A is OMR. Okay, 78% of entity B's finances have been raised in USD. They are talking about B over here. Okay, understand B. 78% of finance they are saying is in US dollar. Right. Then they are saying B's bank accounts are maintained in USD as well as INR. Okay. Cash flows generated by B are transferred to A on a monthly basis in USD in respect of repayment of finance received from A. Revenues of B are in USD. Its competitors are globally based. Tendering for the construction project happened in USD. B incurs 70% of the cost in INR and the remaining 30% in USD. Since B is located in India, can it presume that the functional currency is INR? Okay, B is based in India. Hence, they are saying that the functional currency of an India-based company should be INR. We know it is never like that. Functional currency is representing the primary economic environment of the entity. Certain primary indicators are given, secondary indicators are given, and still there is confusion, then additional indicators are given for a foreign operation. Only on the basis of that we can carry out the analysis whether functional currency of B is INR or maybe some another currency. Okay. It's time really to check the primary, and if confusion, then secondary indicators. Yes. Let me clear up this. We had done analysis for one of the earlier cases. Now let's analyze over here. Let's give importance first to the primary indicators. Okay. They are saying the currency that mainly influences the sale price for the goods and services. Okay, you are going to execute a construction project. They are saying revenues of B are in USD. Okay, Hence, I can say it is USD over here. And then they say the currency of the country whose competitive forces and regulations mainly determines the sale price of the goods and services. Okay. They are saying over here that tendering for the construction project happened in USD. Right. They are also saying its competitors are globally based. Your competitors are globally based. Although you are executing a construction project in India, tendering happened in USD. In other words, the competitive forces of USA, or we can say USD as a currency, is influencing your ultimate selling price. Okay. Then in B, they are saying the currency that mainly influences labor, material, and other costs of providing the goods and services. Okay. What about that? They are saying 70% of the cost will be incurred in INR. Okay. Earlier also that sales was also given. Revenues are based in USD, but the expenses will not be incurred in USD. 70% will be incurred in INR. Okay, here they are saying 70% will be in INR, 30% will be in USD. Slightly confusing, isn't it? In A over here, it is turning out to be USD, while here in B, it is turning out to be INR. Okay, fine, not a problem. We still have secondary indicators. Okay. The currency in which funds from financing activities are generated. Okay, anything given for that? Since B is located in India, okay. Here it is. See, just see over here. They say 78% of entity B's finances have been raised in USD. Has been raised in USD, isn't it? 78%. I can say here 78% is in USD. Then they say the currency in which receipts from operating activities are usually retained. Anything given for that? They are saying cash flows generated by B are transferred to A on a monthly basis in USD. Currency in which receipts are maintained is USD. USD here, USD here, USD here, USD here. Okay, 70% in INR. This is the odd one out. Everywhere else it is the US dollar. If you are asking what is the functional currency of entity B, which is based in India, you are based in India, but your functional currency shall not be INR. Your functional currency shall be USD. Primary, secondary, and additional indicators should be used for the determination of functional currency of B, giving priority to primary indicators. The analysis is given below. Significant revenue and competitive forces in USD. Significant portion of cost is incurred in INR, only 30% in USD. That was the confusing sign in the primary indicators. But then it got confirmed. 78% of the finances are in dollar. It retains its operating cash flows partially in USD and partially in INR. But on monthly basis, we keep on transferring it to USD. Okay. Keeping these factors in view, USD should be considered as the functional currency of B. Functional currency of B shall be the US dollar. Next one. Again, let me just clear this thing off for analyzing the next case. S Limited is a company based out of India which got listed on Bombay Stock Exchange in the financial year ended 31st March 2021. S Limited, it is India based listed company. Okay. Since then, the company's operations have increased considerably. The company was engaged in the business of trading of motorcycles. The company only deals in imported motorcycles. These motorcycles are imported from US. We are importing motorcycles from US, and then it seems you are selling that in India. After importing the motorcycles, these are sold across India through its various distribution channels. The company had only private customers earlier, but the company has also started corporate tie-ups and increased its customer base to corporates also. Earlier, you had only private individuals as your customers, but now you even have corporate clients. Okay. The purchase of the motorcycles are in USD because the vendors from whom these motorcycles are purchased are those all located in US. All other operating expenses of the company are incurred in India only because of its location, and they are generally happen to be in INR. Okay, you are importing the motorcycles from US, so naturally that cost will be incurred in USD. But then there are some other operating expenses also that you have to incur. Those operating expenses are incurred in INR. Currently, its customers are both corporate and private in the ratio of 70:30 approximately. The USD denominated prices of motorcycles in India are different from those in other countries. This is an interesting information. Although you are going to sell, right? They are saying USD denominated prices of motorcycles in India. Although you are going to sell motorcycles in India in USD, the price in USD in India and the price of that motorcycle in USD in other countries will be different. In other words, the rules and regulations of the different countries in which the companies are operating, that is what is influencing the final selling price. The company is also expecting that in the coming years, its customer base will increase significantly in India, and the current proportion may also change. Okay. Currently, the invoices are raised to the corporate customers in USD for the purpose of hedging. However, private customers don't accept the same arrangement, and hence invoices are raised to them in INR. What should be the functional currency of this company? You are selling to private customers as well as to corporates. Corporates do not mind when you are pricing the motorcycles that you are selling in USD. But a private customer like you and me, we will not accept an invoice in USD, right? We want the invoice in INR. In other words, the sales will not necessarily be in USD. The sales will be in INR. After all, if you look at the breakup right now is 70:30. 70% of the customers, they are saying its customers are both corporate and private in the ratio of 70:30. 70% of your customers are corporate customers who will accept in USD, while 30% are private who will be accepting the invoices in INR. Okay. What should we really do over here? Fine. Never jump to the conclusion. Logically analyze the question with respect to the primary indicators and secondary indicators which are mentioned in Ind AS 21. Let us give importance first to the primary indicators. We just want to know which is the functional currency. Okay. They say the currency that mainly influences sale prices for goods and services. This is basically the currency in which the sale price will be settled. Okay. Here what has happened is that 70% of your sales will be in USD, while 30% of your sales will be in INR. After all, 70% of your clients are corporate clients, while 30% are private clients. And this is your sales pattern. And then they say currency of the country whose competitive forces and regulations determine the sale price of the goods and service. There's a very interesting thing in the fact pattern of the case. They are saying that although the price of the motorcycle that you are going to sell in India will be expressed in dollar, but the price of the motorcycle in dollar in different countries will be different. I'll take your attention to that. They say here, right, when you have the 70:30, they say USD denominated prices of motorcycles in India are different from those in other countries. What does that mean? It means the local regulations are also influencing the final selling price. If the competitive forces only of US is affecting you, right, not just you, but all the other vendors in different countries, then the price will be uniform. But the price over here is not uniform. The price of the motorcycle, although expressed in a common currency dollar, in different countries it is different. Why? The motorcycles are manufactured in US. Then you are importing that in India. Import duties will be levied. Now import duty will be decided by the Indian government. Similarly, other vendors in different countries, they are also importing. They will be subject to the laws of those different countries. In different countries, the tax structure will be different. Import duty will be different. The way you are going to be taxed ultimately will be different. And because of that, your selling prices are turning out to be different. In simple words, the competitive forces of US is not affecting you. The competitive forces of India is affecting you. Okay, so when I do this functional currency analysis, it seems it is the INR over here. Okay, let's check here now. The currency that mainly influences labor, material, and other costs of providing goods or services. Okay, you are importing raw material, you are importing motorcycles. Now that cost you have to pay in USD. But all the other expenses, they are to be incurred in INR. This thing is there in the case, we had read it. Yeah, here it is. Purchase price of motorcycle is in USD, hence you will have to make payment in USD. All other operating expenses of the company are incurred in India, and hence it will be in INR. Here it is USD, here it is INR. Just see here, I'm getting USD here, I'm getting INR here, I'm getting USD here, I'm getting INR here. Slightly confusing as far as the primary indicators are considered. Time to give a little bit of importance also to the secondary indicators. Okay. The currency in which funds from financing activities are generated. Okay. Anything given for that? Not much information is really given over here. If I just check with the case, they are saying we import the motorcycles and we are selling in India through various channels. Okay. And not much is really given about the financing pattern over here. Okay. And what more is really there? They are saying the currency in which receipts from operating activities are usually retained. Any information over there? They say currently the invoices are raised in corporate, however private customers do not accept. They are saying what is the functional currency. It seems to be a little bit confusing over here, to be very honest. It is a little bit confusing over here because secondary indicators are not clearly mentioned in the case. Hence I'll have to give due importance only to the primary indicators. Okay, what to do with the primary indicators now? See, both of these conditions need to be fulfilled. Okay, both of these conditions need to be fulfilled. Only then you can say that the functional currency will be a currency other than the presentation currency. Now, when we have read this entire case, it has become more or less clear that although you will be settling 70% of the revenue in dollars, but the competitive forces of US is not affecting you. It is very natural that if you're importing in dollars, you'll have to make payment in dollars, but every other expense is getting incurred in INR. Although the primary indicators are giving mixed signals over here, the better choice for the functional currency seems to be INR. Okay, it seems to be INR. Why? Competitive forces of India seems to be affecting your ultimate selling price. Whatever importing that you are doing, see, importing is a simple transaction, but after you have imported, if you want to sell in India, you will require administrative staff, you will require selling staff. These are the main operating activities that you will have to do in India. Simply importing the motorcycles is one thing, but to generate the revenue, you have to sell that motorcycle throughout the length and breadth of India. And for that, all the expenses are going to be incurred in INR. Although primary indicators are giving a mixed signal, but a better functional currency seems to be Indian rupees. Primary and secondary indicators should be used for the determination of functional currency of S Limited, giving priority to primary indicators. The analysis is below. Ind AS 21 gives greater emphasis to the currency of the economy that determines the pricing of transactions as opposed to the currency in which the transactions are denominated. Although the selling price is denominated in USD, it is the competitive forces of India which is influencing the selling price. Okay, that's the reason we are giving more importance over here to INR. Okay. Sale price of motorcycles are mainly influenced by the competitive forces and regulations in India. The market for motorcycles depends on the economic situation in India, and the company is in competition with importers of other motorcycle brands. 70% of the revenue of the company is in USD. You know, that is what gives you a mixed signal, but we have made it very clear Indian economic conditions are the main factors affecting the prices. This is evidenced by the fact that USD denominated sale price in India are different from USD denominated sale price of the same motorcycles in other countries. How is it possible that different vendors situated in different countries are importing the same motorcycle, but the price in India in USD and the price in USD of that same motorcycle in another country is different? It's mainly because of the Indian regulations. Management is able to determine the functional currency because the revenue is clearly influenced by the Indian economic environment. Expenses are mixed. Okay. Expense pattern is a little bit mixed, the revenue pattern is a little bit mixed, but more importance should be given to the competitive forces of India. On the basis of above analysis, INR should be considered as the functional currency of the company. Let's discuss the crux of Ind AS 21. The crux of Ind AS 21 is how should foreign currency transactions be accounted for? Let me present before you a 4-step guide with respect to the same. But first and foremost, let us be clear with what do we mean by a foreign currency transaction. Basically, a foreign currency is understood as a currency other than the functional currency. Let us say you are having an India-based company. The functional currency of the India-based company is INR. Any transaction that this company is doing which is denominated or is required to be settled in a currency other than INR shall be considered to be a foreign currency transaction. How should these foreign currency transactions be accounted for? Let us see step by step. As I said, there are 4 steps. I will present 4 steps for the purpose of accounting for the same. Accounting of the foreign currency transaction, its segregation into monetary and non-monetary items, its translation as on the reporting date, and finally, what should be the treatment of exchange gain or losses. This is what we are going to understand as a part of our 4-step guide. Okay. To understand this, let us build an illustration. Let us take some figures. Without figures, it is never possible for us to understand how the accounting will be carried out. I don't want to do a theoretical discussion. We take some figures and see how the same shall be accounted for. Let us take a case of a company A Limited. Let's say it's an India-based company and it identifies its functional currency. Let us say as INR. The Indian rupee is the functional currency. Any transaction which is in a currency other than INR shall be understood as a foreign currency transaction. Let us say A Limited on 5th February, let's say, for simplicity, let's take only one single date. On 5th February, it is doing a few transactions. The first transaction, it imports raw material of $10,000. Okay, on credit basis. I'm not writing it, but understand, on credit basis. On that very date, it exports goods of $10,000. To keep things simple, I am leaving the amount as the same. Okay. Then it does a third transaction. Everything happening on 5th February. Okay. It borrows $10,000. And there is one more transaction. It acquires PPE for $10,000. You may wonder why everything at $10,000, only to keep things simple. Our illustration is mainly to understand how the accounting is to be carried out rather than the amounts. Okay, there are 4 transactions and all the 4 transactions are happening on 5th February. As you can see, all the 4 transactions are in USD. USD is a currency other than the functional currency. That means all of these 4 transactions are foreign currency transactions. Now you are maintaining your books in INR. I cannot record accounting entries now in USD. I hope you understand. Your functional currency is INR. That means you are maintaining your books in INR. Now I am not doing a transaction in INR. I am doing a transaction in USD. These transactions which I am doing in USD will be required to be incorporated in my books at INR. That will be the application of step 1 of Ind AS 21. Step 1 is any transaction that you have done in a foreign currency, it should be translated to functional currency at the exchange rate which is prevailing on the date of transaction. My date of transaction is 5th February. I should ask myself that on 5th February, what is the exchange rate? At that exchange rate, I will translate the foreign currency amounts to functional currency amounts. Let us assume for simplicity that the rate is $1 equals to ₹70 on the date of transaction. Hence, what will I do? All these transactions which are denominated in US dollar, it will be translated at 70 rupees and will be converted into Indian rupees. That is the first step. What's the first step? Whatever transaction that you have done in foreign currency, it should be translated to functional currency at the rate which is prevailing on the date of transaction. But it's also very much possible that I may be doing multiple transactions almost every day. You know, every day in a month, I'm doing a lot many transactions. In such a situation, Ind AS 21 also says that if you wish, you can also use average rates. Okay, average rates are also possible. It can be an average weekly rate. It can even be an average monthly rate. If the exchange rates are not fluctuating much, if the exchange rates are more or less stable, then average rates can also be used. Step 1, that's what we are discussing here. Initial recognition at the transaction date. Okay. A foreign currency transaction is initially recorded by translation in the entity's functional currency at the exchange rate on the transaction date. Our illustration, we are doing 4 transactions on 5th February. Whatever is the rate prevailing on 5th February, I will use it. Functional currency will be translated, the foreign currency will be translated to the functional currency. Okay. However, for practical reasons, a rate that approximates the actual exchange rate is often used. An average rate for a week or a month might be used for all transactions in each foreign currency occurring during that period. See, practical considerations should also be incorporated. I am doing one-off transaction. I normally do not import. One-off transaction is done. I normally do not export. One-off transaction. Then it is fine. I can use the rate which is prevailing on the date of the transaction. But every day I am importing. Every day I am exporting. Now, if you are expecting that every day on that date of transaction, find out the exchange rate, latest exchange rate will be computed and then it will be translated, it can make things difficult on the reporting date. For practical reasons, if the exchange rates are stable, use weekly averages. That means during a particular week, whatever transactions I have done at foreign currency, at one common rate, I will convert it into functional currency. I can even use a monthly average. In the month of February, whatever may be my imports, whatever might be exports, at one single average rate, I will translate it into functional currency. This is basically for practical convenience. But remember, averages can be used by us only if the exchange rates are stable. If exchange rates fluctuate significantly, then use of average rate for a period is inappropriate. Conversely, if the exchange rates are stable, you can make use of averages, right? Extending our illustration, what will happen? Let us say on 5th February, the exchange rate is $1 equals to rupees 70. What will this do? You have imported raw materials, right? And we have done it on credit basis. Hence, this will give rise to creditors. Okay, your creditors are basically $10,000, but I will be incorporating that in my books at the exchange rate which is prevailing on the date of transaction, which we have understood as $1 equals to rupees 70. In other words, I will record the creditors in my books at 7 lakhs. I have exported goods, let's say on credit basis. Hence, I am getting debtors. These debtors are of $10,000. I will incorporate that in my functional currency at rupees 7 lakhs. I have borrowed money, right? That means I have a loan. This loan is of $10,000. That will also be recorded in my books at 7 lakhs. And finally, I have an item of PPE, which is basically $10,000, but it will be converted, translated at the exchange rate on the date of transaction. Hence, the item of PPE will be recorded in my books at rupees 7 lakhs. This is what will now be the case. Okay, this is what will happen on 5th February. I have used, right, this is what will happen on 5th February. I have used the exchange rate which is prevailing on 5th February because that is my step 1. Any foreign currency transaction should be initially recorded in our books at the rate prevailing on the date of transaction. I'm assuming over here that we are not using weekly averages. We are using the transaction date rate. And this is what will be the position on 5th February. Okay. Let us say now we are going to close our books on 31st March. On 31st March, I am supposed to finalize my financial statements. What to do now on the reporting date? That's your step 2. Step 2 is the segregation of items in foreign currency. Whatever items that you are having in foreign currency will be required to be segregated into monetary items and non-monetary items. This understanding of monetary and non-monetary is important. As I said, if you are finalizing your books on 31st March, if you are going to now prepare your financial statements on 31st March, then we will have to carry out a further translation of these items. The further translation of these items which are denominated in foreign currency will depend upon whether that item is a monetary item or is it a non-monetary item. Okay, what do we mean by monetary item? What do we mean by non-monetary item? Any item which is receivable, any item that is payable in a fixed number of units of currency will be understood as a monetary item. If it is not so, then it will be understood as a non-monetary item. Okay. Monetary items, non-monetary items. Units of currency held, that's nothing but cash in hand or cash lying in bank. And remember this now, assets and liabilities to be received or paid in a fixed or determinable number of units of currency. You will call this as a monetary item. There is no fixed or determinable number of units of currency. That will be understood as a non-monetary item. Ask yourself, will the liability be settled in a fixed number of units of currency? If your answer is yes, it is monetary. Is this asset receivable in a fixed number of units of currency? If your answer is yes, then it is monetary. If your answer to both of the earlier questions is no, consider that as a non-monetary item. Okay. I will like to return back to my illustration. I will like to know I have creditors, debtors, loan, and PPE. Are these items monetary or are these items non-monetary? Again, very quickly, what do you mean by a monetary item? It is an asset or it may be a liability. If it is an asset, it is receivable. If it is a liability, it is payable. It is payable in fixed or determinable number of units of currency. Okay, you are having creditors. Okay, your creditors are basically $10,000. Remember, creditors are in USD, hence its settlement will happen in USD, although you have converted that into Indian rupees. But when I will settle the creditors, I will not pay creditors 7 lakhs of rupees. I am supposed to pay $10,000 to the creditors. Ask yourself, when you settle the liability in form of creditors, will it be settled by a fixed number of units? When you settle creditors, will you pay $10,000 or will you pay more than that or will you pay less than that? Tell me, you want to settle the creditors. If you want to settle the creditors, you will pay a fixed amount of $10,000. Of course, you may like to pay less. Okay, fine. You may like to pay less, but then rule out that possibility. You have a contractual obligation of paying $10,000. And hence, when you will settle the creditors, you will have to pay $10,000. In other words, the amount to be settled is fixed in terms of number of units. In other words, creditors will turn out to be a monetary item. I hope you agree with me, right? It's a monetary item. Okay. You are also having debtors of $10,000. Although you have recorded in Indian rupees at 7 lakhs, but your sales are export sales. You have invoiced that debtor in dollar, and hence the debtor will make a payment also in dollars. Debtor does not care whether those $10,000 are worth 7 lakhs or 7 lakhs more than that or 7 lakhs less than that. No, the debtor is of the view that my invoice is of $10,000 and hence the debtor will make a payment of $10,000. Debtor is an asset which is receivable in terms of a fixed number of units. Your debtors are a monetary item, isn't it? No debtor will say that, okay, the goods that you have exported is of extremely good quality. I'm so satisfied with your with the goods supplied by you that I'm ready to pay you more. I will like to hear such a thing from the debtors where the debtor is ready to pay something more, but that will never happen. Yes, if the debtor is satisfied, that person will buy more from me. Right, but as far as this contract is considered, the contract will be settled by a fixed number of units. Similarly, you have taken a loan. Tell me, when you repay the loan, will you pay $10,000 or will you pay more than $10,000 or you will pay less than $10,000? Tell me. If you have taken a loan of $10,000, obviously this loan is going to be repaid by making a payment of $10,000. Isn't it going to be settled by a fixed number of units of currency? Answer is yes. And that is the reason this loan is also turning out to be a monetary item. Finally, we have an item of PPE. Okay. When you sell this PPE, tell me, will you get exactly $10,000 or will it be more than that? Or can it be less than that? Tell me. You have an item of PPE which you have purchased for $10,000, right? It's an asset. What will be the receivable from a PPE? Receivable from a PPE can be a possibility when you sell the PPE. When you sell the PPE, you will have to carry out a market valuation. The market valuation may turn out to be more than $10,000. It may even turn out to be less than $10,000. Everything depends upon the market conditions, the nature of the PP, the condition in which the PP has been sold, and a lot many other things. In other words, what I will get from a PPE, what I will receive from this particular asset is not fixed nor determinable in number of units of currency. And that is the reason the item of PPE shall be classified as a non-monetary item. What are we really doing? We're applying the second step of guidance of Ind AS 21 for accounting of foreign currency transactions. The foreign currency items which are expressed in your books, it should be segregated into monetary and non-monetary. For every asset and every liability, ask this question: is the asset convertible into a fixed or determinable number of units of currency? Yes, monetary. No, non-monetary. Ask for every liability: when the liability will be settled, will the payment require a fixed or determinable number of units of currency? Yes, monetary. No, non-monetary. Extending our illustration, this is what I get. Creditors, debtors, and the loan that I have arranged are monetary items, while the PP which I have acquired is a non-monetary item. Yes, returning back to our write-up, certain examples are basically given for monetary and non-monetary items. Okay. Let's first examine the examples for monetary items. They say pensions and other employee benefits to be paid in cash. It is payable in cash. Cash is always fixed, right? That's the reason it is a monetary item. Provisions that are to be settled in cash. Again, cash will be fixed in nature. Lease liabilities, right? Lease liabilities are representing contractual obligations which will be ultimately settled in cash, and that is the reason it is a monetary item. Cash dividends that are recognized as a liability. The moment you use the word cash, it will turn out to be a monetary item. Most debt securities are considered as monetary items because their contractual cash flows are fixed or determinable. Right? You have issued debentures, you have issued bonds. These are nothing but debt securities. These debt securities will be considered to be a monetary item. Ultimately, they are reflecting a liabilities which are required to be settled in fixed or determinable number of units of currency. Non-monetary items, let's consider certain examples which are given. Amount prepaid for goods and services and income received in advance on the basis that no money will be paid or received in the future. Okay, what you are going to get in return in goods, what you are going to get return is services which will not be fixed in nature or which will not be determinable in terms of number of units of currency. Goodwill and other intangible assets, right? These are basically non-monetary item. Even if you see Ind AS 38, Ind AS 38 defines an intangible asset as a non-monetary asset without physical substance, right? In the definition of intangible asset itself, they use the word non-monetary. Inventories will turn out to be non-monetary in nature. When I will sell the inventory, what eventually will I get will depend upon the selling price at that point of time. Similarly, property, plant and equipment, when I sell the PPE, whatever its value at that point of time is what I will get. Right of use assets, these are assets which are emerging out of lease contracts, right? And finally, provisions that are to be settled by delivery of a non-monetary asset. If I am settling a provision in cash, it is monetary item. If the provision is going to be settled by delivery of a non-monetary asset, it will become a non-monetary item, right? Now that you have segregated the items into monetary and non-monetary, now we are supposed to carry out the translation, and this translation is required to be done on the reporting date. I have creditors, I have debtors, I have loan, I have an item of PPE. I'm talking about the illustration that we were discussing. How will I present these items in the financial statements that I will prepare on the reporting date? Okay. Ind AS 21 says that if you are having monetary items should be translated at the closing rate. By closing rate, we mean the rate prevailing on the reporting date. Okay, you have monetary items translated at the exchange rate at the reporting date, that is the closing rate. Returning back to our illustration now, yes, my reporting date is 31st March. Okay, my reporting date is 31st March. What the guidance is suggesting is that whatever are your monetary items should be translated at the rate which is prevailing on the reporting date. Ask yourself, what is the rate on the reporting date? Okay, let us for simplicity say that on 31st March, the rate is $1 equals to rupees 72. Okay, now this item is basically $10,000. $10,000 will be now translated at the rate which is prevailing on the reporting date, which is 72. Hence, in rupees, it will become 7,20,000. Your datas are basically $10,000. It will become 7,20,000. Right? This is $10,000 loan. It will be now recorded, or rather I'll say reported, presented in the financial statements at the rate prevailing on the balance sheet date, which is nothing but the closing date, and hence it is 7,20,000. All monetary items will be translated at the closing rate. However, my item of PP is a non-monetary item. What to do with that? Okay, you have a non-monetary item. Non-monetary items are not translated or restated. Instead, they remain at the exchange rate at the date of the transaction. Getting it? If your item is a non-monetary item, you will not carry any further translation on the reporting date. You will leave them as they are at their historical rate. Okay? This is a non-monetary item. It is of $10,000. Historically, it was recorded at rupees 7 lakhs. I will leave it at its historical rate of 7 lakhs of rupees. Comfortable? Monetary items will be translated at the closing rate, while the non-monetary item will not be translated. Instead, it will be left at its historical rate. However, this is not so for all the non-monetary items. It might be possible that non-monetary items are being presented in your financial statements at their fair values. In that situation, you have to carry out translation of the non-monetary item. For example, here you have an item of PPE. PPE is a subject matter of Ind AS 16. In Ind AS 16, you have a choice of cost model as well as revaluation model. Let us say you are following revaluation model. If you are following revaluation model, then the item of PPE will be reported at its latest fair value. If you are saying latest fair value, then that fair value has to be determined with reference to the latest exchange rate. You get my point? Similarly, you may have intangible assets. Intangible assets are a subject matter of Ind AS 38. Ind AS 38 also offers cost model as well as revaluation model. If your intangible asset has been measured through the revaluation model, then in that particular situation, you will have to use the exchange rate which is prevailing on the date when you determine the fair value. In such a situation, translation of non-monetary items will take place. If you are following the cost model, then in that situation, we will not carry out any translation. That's what they say. However, non-monetary items measured at fair value in a foreign currency as translated at the exchange rate on the date the fair value was determined. Okay, if you have determined the fair value of the PP on 31st March, then use the exchange rate on 31st March. But let us say I applied the revaluation model on 28th February. If you applied the revaluation model on 28th February, then fair value was determined on 28th February. If that is so, then use the exchange rate on 28th February and find out what is the fair value. In other words, further translation for a non-monetary item will be necessary. Life will be much simpler if you are following the cost model. However, when it comes to the translation on the reporting date, we do introduce one more thing, which is the special items. Okay, special items can also be monetary, non-monetary. I'm not getting into it. But these special items are those items whose values are determined by comparing two values. Right? It takes the case of inventories and it takes the case of any asset which is subject to impairment. Think about inventories. How do we value inventories? In Ind AS 2. We value inventory at lower of cost or net realizable value. I will value the inventory at cost or NRV, isn't it? Whichever is lower. Cost is referring to historical cost, and hence I should use over here the historical rate, right? But when you are determining NRV will reflect value on a particular date. The date that you have determined the NRV, on that date, what is the exchange rate? I should use that exchange rate. You can see inventories, they are measured at lower of cost or net realizable value. Then how will I calculate the carrying amount? Just see, cost amount translated at the exchange rate at the date when that amount was determined. In other words, I should use the historical rate. What about the NRV? NRV translated at the exchange rate at the date when that value was determined. When did you calculate the NRV? You say I determined the NRV on 31st March. Okay, fine. Then take the exchange rate on 31st March. But if you say that no, NRV was determined by me on 27th March, whatever is the exchange rate on 27th March, that should be used for calculating the NRV. Then I will compare the cost and the NRV, and the lower of the two will become the value of the inventory. Comfortable? Similarly, it is also quite possible that for your items of PPE or for the items of intangible assets or maybe the ROU asset, there are indications of impairment. Okay, here I will have to apply Ind AS 36. Under Ind AS 36, impairment loss is understood as the excess of carrying amount over the recoverable amount. In other words, the carrying amount shall be compared with the recoverable amount, and accordingly I will calculate that what is the value at which the asset shall be ultimately reported in my balance sheet. Right? You are going to compare carrying amount, recoverable amount. Carrying amount will depend upon the historical cost, so hence use the historical rate. Recoverable amount will be determined on a particular date. On that date, what is the exchange rate? That should be used for the translation of the recoverable amount. Repeat the whole thing now. Right, this cost was something which was relevant for the inventory. Okay, now they are saying carrying amount. Carrying amount will be relevant to PP, intangible assets, right? So here I'll be applying the PP or the intangible asset. They are saying it will be translated at the exchange rate at the date when that amount was determined. When did you acquire the PPE? When did you acquire the intangible asset? Use the rate that was prevailing on that particular date. That will give me the carrying amount. And what about the recoverable amount? Recoverable amount will be translated at the exchange rate at the date when that value was determined. Getting it? You will have to carry out translation of cost or carrying amount or the translation of NRV and the recoverable amount at two different exchange rates. You will compare the two, and then the lower of the two will be selected. And that is how you will come to know that what is the value at which that item shall be ultimately be presented in our financial statements. Now, this can definitely give rise to a typical situation where you may have impairment loss in functional currency, but you may not have that in the foreign currency. Or you may have impairment loss in foreign currency, but you may not have it in a functional currency. This is a very typical situation which is possible because the two amounts are required to be translated at two different exchange rates. They say the above may result in an impairment loss being recognized in functional currency but not in the foreign currency, or vice versa. Think about something like this. Let us say there is an item of PPE where there are indications of impairment, and hence I will compare the carrying amount and the recoverable amount. Okay, I shall compare carrying amount and recoverable amount. Okay, and based on this I want to know that is there any impairment loss. Okay, is there any impairment loss? Okay, first of all, let us consider this in foreign currency. Okay, let us say in foreign currency this is $10,000 and the recoverable amount is $9,500, let us say. Now, if you are seeing the figures in foreign currency, we know that impairment loss is the excess of carrying amount over the recoverable amount. If I ask you that is there any impairment loss in foreign currency, your answer will be yes. I don't want the amount. Amount is very clear, $500. I'm simply asking a question in yes or no. I am having impairment loss in foreign currency. Okay. Now I will like to see these same figures in terms of functional currency. Okay. I want to know that what will be these figures in functional currency for this item of PPE, functional currency. Let us say for the purpose of translation here, the rate that is to be applied is 70 rupees. Hence, this will be recorded at 7 lakhs. Okay. While here, the rate is, let's say, 72. So 9,500, I'm multiplying at 72. Or let us, just a second, I'll have to take some another rate over here. Let us say for the purpose of translation, the rate over here is 75. 9,500, I'm translating at 75. I am getting here 7,12,500. Just see here. Carrying amount is translated to the functional currency. The functional currency carrying amount is 7 lakhs. While the translation of the recoverable amount, it is giving me 7,12,500. Recoverable amount in functional currency is greater than the carrying amount. Hence, if you ask yourself that do you have an impairment loss in functional currency, the answer is turning out to be no. We are not having any impairment loss in a functional currency. So a very typical situation, in foreign currency I have impairment loss, but in functional currency I do not have the impairment loss. Okay. Or when it again comes to the functional currency, let us take another exchange rate this time. Let's say the exchange rate over here is 70, right? Over here it is 70. So this is giving me rupees, or we'll have to take, just a second, you'll have to take fresh figures only, then only it will become more clear. Okay. Let's think in this way. In foreign currency, let us say this is $10,000 and this is $10,500. Okay, $10,500. Now, in foreign currency, I will compare the carrying amount and the recoverable amount. I realize over here that the carrying amount is lower, the recoverable amount is higher. That means in foreign currency, there is no impairment loss. Okay, in foreign currency, there is no impairment loss. Now I want to know what will be the situation in terms of the functional currency. Okay, in terms of functional currency. Let us say on the reporting date when you are carrying out the translation, right? Here I'll have to use the historical rate. The historical rate, let's say, is 70. And hence I'm recording this at 7 lakhs of rupees. But when you are calculating the recoverable amount, you have to use the rate which was prevailing on the date on which you determine the recoverable amount. Let us say that rate is turning out to be 65. So 10,500 I multiply by 65. I am getting over here 6,82,500. This is the other typical situation. In foreign currency, there is no impairment loss, but in functional currency, there is an impairment loss. So when the carrying amount which is getting translated at historical rates and the recoverable amount which is getting translated at the rate on the date on which you calculated the recoverable amount, when you are doing this, it can give rise to a typical situation where, yes, in the first instance, there is impairment loss in foreign currency, but no impairment loss in functional currency. Or the second typical situation where there is impairment loss in functional currency, but no impairment loss in the foreign currency. So such kind of typical situation can definitely arise. Okay. Let us now move into the final step, step 4. Now, as you can see, monetary items are getting translated at the closing rate, while the non-monetary items will normally not be translated unless and until they are to be reported at the fair values. Now, what will happen is the rate at which you had included these items initially and the rate at which you are now supposed to present them in your financial statements on the reporting date, the rates may be different. And if the rates are different, it will give rise to exchange differences. These exchange differences may be a foreign currency gain or it can be a foreign currency loss. What to do with these exchange gains or losses? That is the final step of the guidance available in Ind AS 21 in respect of accounting of foreign transactions, right? We are basically referring to recognition of exchange differences, which is nothing but foreign exchange gains and losses. Remember, if the foreign exchange gain or loss is for a monetary item, it should be recognized in profit and loss account subject to certain exceptions. Non-monetary items will normally not result into any kind of exchange difference, but by chance if there is an exchange difference, it should go to the P&L subject to again certain exceptions. Okay. I will like to return back to our illustration. This was the illustration that we were building, isn't it? So this is the situation that we are having. Now what I am saying is something, this. This was originally recorded at 7 lakhs, but now it will be updated to 7 lakh 20. This was 7 lakhs updated to 7 lakh 20. This was 7 lakhs updated to 7 lakh 20. This is 7 lakhs. It has still remained 7 lakhs. The last item was the item of PPE, which is a non-monetary item. Normally for non-monetary items, you will not have exchange differences, but you will have exchange differences for monetary items. Okay. Hence, I am now introducing over here what I am referring as exchange difference. Okay, exchange difference. Remember, the exchange difference can be a gain, exchange difference can be a loss. I am getting over here, okay, I am getting over here an exchange difference of 20,000, here also 20,000, here also 20,000, and here I am getting no exchange difference at all. Okay, these are all monetary items, right? Look at the first one. If you have forgotten, the first one is creditors. The second one is debtors. The third one is a loan. And the last one is an item of PP. For an item of PP, there are no exchange differences. Hence, no further accounting is required to be done. But for monetary items, if there is any exchange difference, this exchange difference should be recognized in profit and loss account, of course, subject to certain exceptions which are given in Ind AS 21. Okay. Now, let's understand the nature of the exchange difference. The first item is a creditor. Value of your creditors has increased by 20,000. If a liability has increased, then it is representing a loss. Hence, I am having an exchange loss of 20,000. The second item is a debtor. Value of the debtor has increased from 7 lakhs to 7 lakh 20. Increase in debtors is increase as an asset. If it is an asset, then there is an exchange gain of 20,000. You are having a loan, you have borrowed money. Okay, you have not advanced a loan, you have borrowed money. This loan is representing a monetary item, agreed. But ultimately loan is a liability. Increase in the value of a liability is loss over here. And hence I am having a loss of rupees 20,000. As per the guidance which is given, yes, this loss of rupees 20,000, yes, this loss of rupees 20,000 will be recognized in profit and loss account. This gain of rupees 20,000 will be recognized in profit and loss account. And you are also having a loan. Here, there may be a slight application of the exceptions. So let us first be clear whether the loan will become a part of the exception, yes or no. As far as the non-monetary item is considered, there is no exchange difference and hence no further treatment is applicable over here. Step 4. This is what we were discussing. Monetary items, right? They are saying any exchange difference which is there for a monetary item recognized in P&L subject to certain exceptions. We will discuss that. Non-monetary items, usually there are no exchange differences, but if there are any recognized in P&L subject to certain exceptions. Even for non-monetary item, by chance if you are having any exchange difference, let it go to the P&L. Okay, let's understand the exceptions over here. Monetary items, what are the exceptions? Exchange difference arising out of hedge accounting. Hedge accounting has to be done as per Ind AS 109. Okay, any exchange difference which is a part of hedge accounting do not apply Ind AS 21. That means do not recognize that in the P&L. Detailed guidance is given in Ind AS 109 that how that should be accounted for. Okay, then they are saying for long-term foreign currency monetary items, in case the entity has exercised the option for recognizing the exchange differences on such items in equity, there is a separate Ind AS 101. This Ind AS 101 deals with the first time adoption of Indian accounting standards. Now see, right now you will be following the regular accounting standards, and now you are supposed to translate to the Ind AS system. Till now I was following accounting standard 11. Now in accounting standard 11 for long-term monetary items, okay, they are talking about the foreign currency monetary items, long-term monetary items, AS 11 gives a typical choice. It is suggesting that if an entity wishes, then whatever are the foreign currency gains or foreign currency losses, it can be transferred to a foreign currency monetary item translation difference account. You know, it is popularly known as FCMITD account. This is something that I am discussing with reference to accounting standard 11. I am having long-term monetary items, whatever are the exchange gains or losses with respect to it, instead of taking it to the P&L, I will take it to the FCMITD account, foreign currency monetary item translation difference account. This is what is given in AS 11. Now, I am switching over from AS 11 to Ind AS 21. But when I am adopting the Ind AS for the first time, Ind AS 101 gives me an exemption. Ind AS 101 says that, see, you are following this typical treatment of AS 11. Do you want to continue with this typical treatment even after switching over to the Ind AS? If as an entity I exercise this exemption, then this item will not be covered by Ind AS 21. This item will continue to remain covered as per the typical treatment of AS 11. And hence it works as an exception. Finally, monetary items that form part of the reporting entity's net investment in a foreign operation are recognized as under. Okay, the monetary item for which you have determined the exchange difference, this monetary item is actually a part of net investment in foreign operation, then it will be treated slightly differently. Okay, what that treatment will be, that is what we will be discussing now over here. But before going into the details, I want to also complete for the non-monetary items first, then we discuss this net investment in foreign operation at a greater length. What is the exception over here? Non-monetary items, we know they will be continued to be translated at historical rate. Hence, for majority of the non-monetary items, there shall not be any exchange differences. By chance, if there is an exchange difference, let it go to the P&L. However, and this is the exception that we are discussing, if the exchange difference is arising on account of fair value changes, and if the respective Ind AS which is applicable to it wants you to recognize the fair value changes in OCI, then the exchange difference will be also recognized in OCI. Getting it? For example, you are following the revaluation model for the PPE. Now, whatever is the revaluation gain which is covered by Ind AS 16 will not go to the profit and loss account. You will rather transfer it to OCI by making it a part of the revaluation reserve, isn't it? If revaluation reserve is going to be recognized in OCI, exchange difference relating to it will be also recognized in OCI. Comfortable? They say exchange differences arising on revaluation gain or loss of PPE or intangible assets when revaluation model is adopted are recognized in other comprehensive income. If you are going to recognize that in OCI, then the exchange difference should also be recognized in OCI. For example, you are doing revaluation of an item of PPE. Okay, after 2 years, again you are doing revaluation. First time there was a revaluation gain, second time there was a revaluation loss. This revaluation loss will be adjusted against revaluation surplus, right, in the OCI. Exchange difference relating to that will also be recognized in OCI. Okay, let us again return back to the monetary items. The third exception: if the monetary item is a part of net investment in a foreign operation, then it shall be treated slightly differently. Further guidance is given in Ind AS 21. They are saying net investment in a foreign operation. First of all, let us be clear with what do we mean by a foreign operation. By foreign operation, we mean a branch, subsidiary, joint venture, or an associate which is located in a foreign country. That is what we will understand as a foreign operation. And then we are using the word net investment. What do we mean by net investment? Obviously, net investment will be understood as net assets, right? Net investment, it refers to the amount of the reporting entity's interest in the net assets of foreign operation. Okay, net assets. We are saying net investment in foreign operation. Okay, net investment in foreign operation. Basically, the net investment in foreign operation is equal to net assets of foreign operation. Okay, net assets of foreign operation. Net assets is nothing but assets minus liabilities. But if you take the balance sheet equation, assets minus liabilities will be equal to share capital plus reserves and surplus. In other words, the net assets is nothing but share capital, right? Share capital plus reserves and surplus. Okay, now share capital is not representing a monetary item. Reserves and surplus is not representing a monetary item. Hence, a question arises that when we are discussing exceptions to monetary item, why are we including net investment in foreign operation? Because in the concept of net investment of foreign operation is net assets, and net assets have nothing to do with monetary items. Share capital will be understood as a non-monetary item. Reserves and surplus will be understood as non-monetary item. Where is a monetary item over here? And if there are no monetary items over here, then why are we considering this to be an exception? Let us understand that thing now. Normally, net assets will not include monetary items. Normally, the net investment in foreign operation will not include monetary items. But because we are discussing exceptions, there are exceptions even over here where a monetary item may also get included as a part of net investment in foreign operation. Let us understand this. How will this thing really happen? Okay. Let us say you have A Limited, and this A Limited has a foreign subsidiary. Okay, A Limited is an Indian company. It has a foreign subsidiary, B Limited. And what A Limited has done is it has advanced a long-term loan. It has advanced a long-term loan to its subsidiary, B Limited. Okay, we are taking this particular situation where you have an India-based parent. This India-based parent is having a foreign subsidiary, okay, and the India-based parent has granted a long-term loan to its subsidiary. It is a loan. Loan is required to be repaid by the subsidiary in fixed or determinable number of units of currency, and hence this loan is a monetary item, right? It is a monetary item. Now, the terms and conditions are that this loan is to be repaid by B Limited, but parent has no intention of asking its subsidiary to repay this loan. Okay, parent has no intention of doing that. Parent has given a loan to the subsidiary. Of course, terms and conditions will be there, but parent also knows and subsidiary also knows that this loan is never going to be repaid. Parent has no intention of calling back this loan. Can I say that this is as good as infusement of capital by the parent in its subsidiary? What do you say? Parent is giving a loan to the subsidiary with an intention of never asking the subsidiary to repay this loan. Isn't this as good as infusing capital? Instead of this, let us say the subsidiary has issued shares and parent had invested in those shares. This is also one way in which you will infuse the capital. Giving this loan which is never going to be repaid is also as good as a part of infusement of capital, and hence this loan will be considered to be a part of net investment in foreign operation. Okay, parent has invested in the equity shares of the subsidiary. Parent has now also given a long-term loan to its subsidiary. This long-term loan will be also considered to be a part of the net investment, and because it is a part of the net investment, at the end of the day it is a monetary item, and hence it's a monetary item, it will become a part of the exception. So discussing over here, as you can see, net investment in foreign operation was basically understood as a share capital plus reserves and surplus. But now I will also have to include over here, okay, I'll also have to include over here long-term loan, right? Long-term loan, which is whose repayment is not going to be demanded. Okay, long-term loan, we can say here non-repayable long-term loan. But since it is a loan, at the end of the day, it is a monetary item. And because it's a monetary item, it will have exchange difference. How will this exchange difference be treated? That is a part of the exception. Right, coming to the net investment in a foreign operation. This refers to the amount of the reporting entity's interest in the net assets. We discussed that. Now, how is a monetary item going to become a part of it? Just see. A monetary item receivable from or payable to a foreign operation forms part of net investment in a foreign operation if the settlement of the monetary item is neither planned nor likely to occur in the foreseeable future. Again, parent has given a loan to the subsidiary. Its repayment is not going to happen in the foreseeable future. Consider this to be as good as investment in the foreign operation and hence include it as a part of the net investment in foreign operation. Such monetary items may include long-term receivables and loans, but do not include trade receivables or trade payables. Trade receivables, trade payables are short-term assets, short-term liabilities. They are definitely going to get settled in the foreseeable future and hence do not include them. But if you are having long-term items which are not going to be settled in the foreseeable future, please make it a part of net investment in the foreign operation. See, it can be even other way around also. Okay, it can even be other way around also. You have A Limited, India-based company. You have a foreign subsidiary over here, which is B Limited, and this time B Limited is giving a long-term loan. Right, the subsidiary is giving a long-term loan to the parent and it is not to be repaid in foreseeable future. Let's say this is how it is. Parent will not repay this particular loan. This is like withdrawing the capital from the subsidiary. This time this item will be deducted when you are calculating the net investment in the subsidiary or net investment in the foreign operation. I will say share capital plus reserves and surplus, and this item I will deduct. This loan which you have taken from the subsidiary is like withdrawing cash from the subsidiary. It is like withdrawing the capital that you invested. This will be deducted. Whether it will be added or deducted doesn't really matter much, because at the end of the day, it will become a part of the net investment in the foreign operation. Hence, it is a monetary item, right? Loan ultimately is a monetary item, but this monetary item will be a part of the net investment in foreign operation. How should its accounting be carried out? I mean, how will the exchange difference be treated? Okay, they say in separate or individual financial statements, you should recognize in the P&L. In consolidated financial statements, it will be initially recognized in OCI, and then it will be reclassified from equity to profit and loss on disposal of the net investment. Initially recognized in OCI, and then ultimately when you dispose of that net investment, at that time you can take a transfer to the profit or loss. Okay, let's understand this in separate or individual financial statements. Okay, let's understand this. The first situation, let's put it this way. A Limited has granted this particular loan to the foreign subsidiary B Limited. We know ultimately it is a monetary item. Let us say for this monetary item, there is an exchange difference representing a loss of 10,000. How is it to be treated? When you prepare separate financial statements of A Limited, separate financial statements, this 10,000 will be recognized in the P&L of A Limited. In separate financial statements, A Limited and your subsidiary B Limited are two separate entities, and that's the reason let it go to the P&L. But when you prepare CFS, consolidated financial statements, in consolidated financial statements, parent and subsidiary will be considered to be a single entity. When parent is giving a loan to the subsidiary, when you are preparing separate books, it is fine. But when you say consolidated financial statement, now parent and subsidiary is a single company. If it is a single company, you cannot give loan to yourself, book a profit or a loss and recognize that in the P&L. I hope you are getting my point. When I prepare CFS, parent and subsidiary will be considered to be a single entity. Now I cannot do a transaction with myself and recognize that in the P&L. This will be considered to be a transaction amongst the owners. You should consider this in OCI. In other comprehensive income, I can maintain a separate reserve. Let us say foreign currency translation reserve. Okay, this 10,000 rupees of loss will be debited to foreign currency translation reserve. I will make it a part of the other comprehensive income. Yes, it's quite possible that few years down the line, I sell away my shares of the foreign subsidiary. Okay, I am disposing of my net investment in the foreign subsidiary. At that time, whatever balance is lying in the foreign currency translation reserve, it will be transferred to the P&L. Till that point of time, it will remain in equity. When I say equity, it will be a part of OCI. When I say OCI, it will be a part of a separate reserve. Comfortable? Similarly, for that other possibility also, right, it's a monetary item. What happens is, let us say for B Limited, let's assume in this way, there is a gain of rupees 5,000. When B Limited is preparing its individual financial statements, okay, it will prepare its individual financial statements. This 5,000 will be recognized in profit and loss account. But when you are preparing CFS, okay, when you are preparing CFS, A Limited and B Limited will be considered to be a single entity. You cannot do a transaction with yourself, book a gain of 5,000 and transfer it to the P&L. This time, this gain will go to OCI. We will consider this as a transaction between the owners, and hence I will recognize that in equity. That is basically OCI. That is basically making a part of a separate reserve, foreign currency translation reserve. And yes, a day may come or may not come. See, we don't know. But a day may come when you may sell away the shares of the foreign subsidiary. When you dispose of the foreign subsidiary, at that point of time, whatever gain which was lying or whatever loss that was lying in the foreign currency translation reserve, from equity, it will be reclassified to the profit and loss account. That means I will take a transfer to the P&L. At times it is possible that I may sell the foreign, I may dispose of the foreign operation, but only partially. Then to the extent I have disposed of, to that proportion I can take a transfer from foreign currency translation reserve to the P&L. So coming back to the illustration that we were discussing earlier, right? We are having this item loan, okay? Let us modify it now. Let us say it is a long-term loan. Now, long-term loan is definitely a monetary item, and I realize that for this monetary item, there is a loss of rupees 20,000. Okay, we are referring to this. There is a loss of rupees 20,000. I should ask myself, is this long-term loan? Okay, is this long-term loan part of net investment? Okay, part of net investment in foreign operation. Okay, in foreign operation. This is the question that I should ask myself. Okay, let us say the answer is turning out to be no, that it is not a part of net investment in foreign operation. Then it is a regular monetary item. If it is a regular monetary item, this 20,000 rupees loss will be recognized in the P&L. Okay. But what if the answer is yes over here, that yes, it is a part of net investment in foreign operation? Okay. Then I will classify this as separate financial statements or individual financial statements and consolidated financial statements. Okay. In separate financial statements, I will recognize that in P&L. In CFS, I will recognize it in foreign currency translation reserve, that is in equity, as a part of my other comprehensive income, right? So that is what we are referring over here. Ultimately, separate financial statements recognized in the P&L, consolidated financial statements in OCI as a part of equity, and when you dispose of the foreign operation, at that time reclassify from equity to the P&L. This basically gives you a detailed understanding of how the foreign currency transaction should be accounted for. Very quickly, if I run you through it, step 1, whatever is your foreign currency transaction, translate at the rate which is prevailing on the date of transaction. Okay, average rates can be used provided exchange rates are stable. Step number 2, you are now having assets and liabilities which are denominated in foreign currency. Please identify whether they are monetary items or non-monetary items. If the item is an asset or a liability which is going to be received or paid in fixed or determinable number of units of currency, it is a monetary item. Otherwise, it is a non-monetary item. Okay. On the reporting date, translate monetary items at closing rate. Non-monetary items usually will not be translated, although there are certain exceptions. Finally, what to do with the exchange difference? Exchange difference of monetary items will be recognized in profit and loss account. However, if the monetary item is a long-term receivable or the monetary item is a long-term payable and it is forming a part of the net investment in foreign operation, then in separate financial statements or individual financial statements, recognize that in the P&L. In consolidated financial statement, recognize the exchange difference in OCI, which will ultimately be recognized in the P&L as and when the net investment in foreign operation is disposed of. Exchange differences arising on non-monetary items. Normally, there will be no exchange differences and hence no further treatment is required. By chance, if there are exchange differences, then recognize that in the P&L, subject to an exception. If the exchange differences for those items which are actually recognized in OCI, then the exchange difference will be also recognized in OCI. On 1st January 2018, P Limited purchased a machine for $2 lakhs. The functional currency of P Limited is rupees. At that date, the exchange rate was $1 equals to rupees 68. P Limited is not required to pay for this purchase until 30th June 2018. Rupee strengthened against the dollar in the 3 months following purchase, and by 31st March 2018, the exchange rate was $1 equals to rupees 65. CFO of P Limited feels that these exchange fluctuations wouldn't affect the financial statements because P Limited has an asset and a liability denominated in rupees, which was initially the same amount. He also feels that P Limited depreciates this machine over 4 years, so the future year-end amounts won't be the same. Examine the impact of this transaction on the financial statements of P Limited for the year ended 31st March 2018 as per the Ind AS. They haven't given us the applicable Ind AS, but by reading the question, it is very clear it is a case of Ind AS 21, isn't it? You are purchasing a machine for $2 lakhs. You are buying that on 1st January 2018. You are doing a foreign currency transaction. Step 1 of Ind AS 21 is that you should be recording the foreign currency transaction at the rate prevailing on the date of transaction. On 1st January 2018, the exchange rate is 68 rupees a dollar. What I will do on 1st January 2018 is, right, I will say machine, or you can say it is PPE account debit. And they are saying that we will make the payment only on 30th June 2018. I can say to supplier account, isn't it? And it is $2 lakhs and the rate on that date is 68. So we take 2 lakhs and multiply that by 68. It is turning out to be 1 crore 36 lakhs. The machine will be recorded at 1 crore 36 lakhs and the liability will be also recorded at 1 crore 36 lakhs. Okay. Then they are saying rupee strengthened against the dollar in 3 months following the purchase, and by 31st March 2018, the exchange rate was 65 rupees a dollar. 31st March 18 seems to be the date on which you will be finalizing your financial statements, right? They are themselves making it very clear at the end that financial statements are to be prepared on 31st March 2018. 31st March 2018 is the reporting date. Apply step 2 of Ind AS 21 now. Step 2 is to identify the assets and liabilities and classify them into monetary items and non-monetary items. Okay, here you are having 2 items, PPE and the supplier. Okay, I am now supposed to decide whether the PPE is a monetary item or a non-monetary item, and whether the supplier's account is a monetary or a non-monetary item. Okay, what is a monetary item? An item which is representing an asset or a liability which is receivable or payable in a fixed or determinable number of units of currency. You have purchased a machine for $2 lakhs. See, you have recorded the supplier at 1 crore 36 lakhs, agreed, but you are not supposed to pay 1 crore 36 lakhs to the supplier. You are supposed to pay $2 lakhs to the supplier. This is an amount which is actually fixed. And hence the supplier which is representing a liability will be classified as a monetary item. Insofar as PPE is considered, as on 31st March 2018, if you are selling this PPE, you may get $2 lakh, you may not get $2 lakh. In other words, the value of PPE is not fixed or determinable in terms of number of units of currency. Hence, PPE will be classified as non-monetary item. The supplier representing a liability will be classified as a monetary item. Right? Then you have to apply the third step. Monetary items will be translated at closing rate, while the non-monetary item will be continued to be recorded at its historical rate. Okay. So if I am giving effect of the same, what I am saying is that PPE will be considered to be non-monetary, and supplier, which is representing a current liability actually, will be classified as a monetary item. Monetary item will be translated at the closing rate, right? The rate which is prevailing on the reporting date. and non-monetary item will be ignored, or I would rather say it will be continued to be recorded at the historical rate, right? That will be a better choice of words. I'll say it will be continued to be recorded at the historical rate. Okay, let us do that now. 31st March 2018. Okay, I'll have to work out what is the value of the supplier now. It will be $2 and the rate now is 65. So it is turning out to be 1 crore 30 lakhs. You will have to translate the supplier, and the supplier is now having a value in Indian rupees, that is the functional currency, at 1 crore 30 lakhs. Originally you had recorded the supplier at 1 crore 36 lakhs. Now the supplier should be retranslated at 1 crore 30 lakhs. You will have to decrease the value of the supplier. Liability is decreasing by 6 lakhs. Decrease in liability of rupees 6 lakhs will be considered to be a gain, and this gain will be recognized in profit and loss account. Step 4. Step 4 is that the exchange differences relating to the monetary item should be recognized in the P&L, subject to certain exceptions. This is not falling in that exception. So what we are saying is, what we suggest is decrease in liability, right? Liability is decreasing by 6 lakhs. This is gain. It's a foreign exchange gain. You can say exchange difference, whatever. You should transfer this to profit and loss account. Let it go to the P&L. Okay. And then they are talking about the machine. They are saying it will be depreciated over 4 years. Okay. We are going to depreciate it over 4 years. Fine. We work out the depreciation. Depreciation for PPE, let's calculate that. It is 1 crore 36 lakhs, right? The PP will be continued to be recorded at its historical cost. They haven't given us any salvage value, and hence I divide this by 4 years. This will give me depreciation for 1 full year. But you purchased the machinery on 1st January 2018, and we are providing depreciation up to 31st March 2018. That means we are providing depreciation only for 3 months. Hence, I will multiply this by 3 by 12. Okay. The amount of depreciation that we need to provide is 8,50,000. I will provide a depreciation of 8,50,000. This 8,50,000 I will deduct from 1 crore 36 lakhs. When you prepare your balance sheet on 31st March 2018, you will report the PP at 1 crore 27 lakhs 50,000, right? 1 crore 36 lakhs minus the depreciation 8,50,000. I will report my PP at 1 crore 27 lakhs 50,000. So on 1st January 2018, we will initially record at 1 crore 36 lakhs. You can see our workings. PP will be recorded at 1 crore 30 lakhs. Supplier will be also recorded at 1 crore 36 lakhs. Liability is a monetary item. It will be translated using the rate of exchange in force on 31st March 2018. Hence, liability will become 1 crore 30 lakhs. Right here it is 1 crore 30 lakhs. Liability is reducing from 1 crore 36 lakhs to 1 crore 30 lakhs. This is representing a gain, and that should be recognized in the P&L. Now here they are saying there's a slight correction to be made. They are saying the loss on retranslation of 6 lakhs. Sorry, it is not loss. Okay, it is not loss. It is gain. gain on retranslation. This is a solution which is there even in your study module. In study module also they have used the word loss. That's the reason I have purposefully kept it in this way. You must understand that if there is a reduction in a liability, then reduction in liability will be a gain. It will not be a loss. Gain on retranslation of 6 lakhs is recognized in the statement of profit and loss. Yes, we should credit it to the P&L. PP will be a non-monetary asset. It will be continued to be recorded at historical cost, right? So there will be no change in the value of the PPE. And then as we had understood, we have to provide depreciation. This is how we calculated the depreciation for the PPE, 8,50,000. Depreciation amount is turning out to be 8,50,000. As you can observe, 8,50,000. Depreciation definitely will be debited to the P&L, and closing balance of the PPE will be 1,27,50,000. This will be shown as non-current asset in the balance sheet, right? If you are preparing an extract of balance sheet, right, you will say non-current assets. And in non-current assets, you will be showing PPE at 1,27,50,000. And in liabilities, you will be showing current liabilities. And in current liabilities, you will report the supplier at 1,30 lakhs. This will be the balance sheet as on 31st March 2018. This is how your extract of the balance sheet will look like. Okay, extract of the balance sheet. And if you are preparing extract of profit and loss statement, you will be showing depreciation as an expense, 8,50,000. And you shall also be showing translation gain. Your translation gain will be 6 lakhs. Translation gain will be credited to the P&L and the depreciation will be debited to the P&L. Well, that's the end of our answer. Supplier A Limited enters into a contract with a customer B Limited on 1st January 2018 to deliver goods in exchange for a total consideration of $50 million and receives an upfront payment of $20 million on this date. The functional currency of the supplier is INR. Functional currency is INR, that means USD will become the foreign currency, right? Any currency other than the functional currency is a foreign currency. The goods are delivered and revenue is recognized on 31st March 2018. $30 million is received on 1st April 2018 in full and final settlement of the purchase consideration. State the date of transaction for advance consideration and recognition of revenue. Also state the amount of revenue in INR to be recognized on the date of recognition of revenue. Exchange rate on 1st January and 31st March 2018 are 72 and 75 rupees a dollar respectively. Okay. The total consideration is 50 million USD. Right, we are having a contract of USD 50 million. And you have received it in 2 installments. There is an upfront payment. On 1st January 2018, there is an upfront payment of 20, while the remaining is received on 1st April 2018. But you are delivering the goods on 31st March 2018, right? So 31st March 2018 is the time when the remaining $30 million are also becoming due. Okay, so this is what we are getting. USD 50 million split into 1st January 2018 and 31st March 2018. The rates then on 1st January and 31st March 2018 are 72 and 75. So that is what you should be doing. This you should multiply by 72 and this you should multiply by 75. It is very clear. The step 1 of Ind AS 21 for accounting of foreign transactions is very clear. Foreign currency transactions is very clear. You are supposed to translate initially at the rate which is prevailing on the transaction date. When you are doing a transaction on 1st January 2018, the rate is 72. Hence 20 million that you have already received in advance, revenue will be recognized at 72 rupees a dollar. Finally, you are delivering the goods on 31st March 2018. Hence, for the balance $30 million that you are going to receive, recognize revenue at 75 rupees a dollar. Whatever answers you are getting over here, this is what we should be doing. 20 into 72, it is turning out to be 1440, and 30 into 75, this is turning out to be 2250. Okay. This is the revenue. This is the total revenue that we should be recording. This will be your total revenue recognized. And of course, the revenue will be recognized on 31st March 2018. After all, 31st March 2018 is the date when you are delivering the goods. Your contractual commitment is getting completed on 31st March 2018. The moment the goods are delivered, you can now recognize revenue. But you will recognize revenue at two different rates. For the advance consideration, you will recognize revenue at 72 a dollar, and for $30 million which will be receivable at a subsequent date, you have to recognize revenue at 75 rupees a dollar. What is the logic? The logic is simple. Step 1 of Ind AS 21. What is step 1? Recognize the foreign currency transaction, or rather I will say translate the foreign currency transaction at the rate prevailing on the date of the transaction. On the date of transaction of $20 million, the exchange rate is 72 rupees. So use that. And for remaining 30, it is 75. Use the same. Okay. Not only that, this $30 million, right? This $30 million that you have is at the end of the day a receivable. Because it's a receivable, it will be a monetary item, and we know that monetary items are required to be translated at the closing rates. However, 30 million is going to be received on 1st April 2018. In terms of the question, they are saying that 30 million will be received on 1st April 2018. That means the very next day you will receive the money. You will recognize the receivable on 31st March 2018, and the next day you are going to receive the payment. In case if there is any exchange fluctuation, you should be recognizing that in the P&L. Okay. One more point that you have to keep in mind, this advance that you are going to show, right? You are going to show advance. The advance that you are going to have shall be a non-monetary item, right? Do not consider the advance to be a monetary item. Do not be of the view that this figure on 1st January 2018 was translated at 72, and hence by the time it is 31st March 18, we will now translate it at 75. That will not happen. Okay. The advance that you are receiving is going to be settled by delivery of goods, not delivery of cash. Goods or the inventory shall be considered to be a non-monetary item. This is an advance payment which is going to be settled by a delivery of a non-monetary asset. Such kind of advance payments shall be considered to be a non-monetary item. If it is a non-monetary item, it will be continued at its historical rate. That is the reason that $20 million that you received on 1st January 2018, revenue will be recognized at the rate on 1st January 2018, which is 72 rupees a dollar. Right, A Limited will recognize a non-monetary contract liability amounting to 1440 million. This is nothing but $20 million multiplied by 72. More important is it is a non-monetary item. Okay. A Limited will recognize revenue on 31st March 2018. This is the date when you are transferring the goods to the customer. That's the reason revenue recognition will happen on 31st March 2018. Okay. And for USD 20 million, revenue will be recognized on the date of transaction, which is 1st January 2018. For the remainder of the goods, the transaction date will be 31st March 2018. So what will happen on 31st March 18? You will de-recognize the non-monetary liability of 20 million and recognize 20 million of revenue using the exchange rate of 72 rupees a dollar. Okay. 1st January 2018, you are showing a non-monetary contract liability. Close that account now and transfer it to the P&L, transfer it to revenue. Recognize revenue and a receivable for the remaining 30 million using 75 rupees per dollar. And the receivable will be a monetary item, so it should be translated using the closing rate until the receivable is settled. Well, that's the end of our answer. On 30th January 2020, A Limited purchased a machinery for $5,000 from USA supplier on credit basis. A Limited's functional currency is the rupee. The exchange rate on the date of transaction is $1 equals to rupees 60. The fair value of the machinery determined on 31st March 2020 is $5,500. Okay. 30th January 2020, you are purchasing a machine for $5,000. We know that whenever you are doing a foreign currency transaction, initially it should be recorded at the rate prevailing on the transaction date. Your transaction date is 30th January 2020, and on that date the exchange rate is 60 rupees. I will record the plant and machinery or the item of PPE at $5,000 translated at rupees 60. $5,000 into 60, that will turn out to be rupees 3 lakhs. Interesting thing is this, they say fair value of the machinery on 31st March 2020 is $5,500. Normally they will not give you the fair value of machinery, but since they are giving the fair value, indirectly they are trying to tell us that we are going to follow the revaluation model of Ind AS 16. You are going to acquire a machinery, initial recognition will be at cost. Cost will be decided by the exchange rate prevailing on the transaction date. And later on 31st March, we are doing revaluation and we realize that the fair value is now 5,500. Okay. The exchange rate on 31st March 2020 is rupees 65. Machinery is understood as a non-monetary asset. Non-monetary assets are continued to be recorded in our books at their historical rates unless and until their fair values are determined. Since you are following the revaluation model, you have to work out the latest value of the machine. Latest value of machine in dollar is 5,500, but in rupees it will be available when I will convert 5,500 at 65. Whatever was the originally recorded value of the machine and whatever is its latest fair value, the difference between the two is the revaluation gain or the revaluation surplus, which we should recognize in OCI, other comprehensive income. We will recognize it by making it a part of the revaluation reserve. Payment to overseas supplier will be done on 31st March 2021. Okay, 1 year after that we are making the payment and the exchange rate at that time is 67. Fair value of the machinery remain unchanged for the year ended 31st March 2021. Fair value is remaining unchanged. What they are trying to suggest is that there is no need to do a fresh revaluation. Whatever revaluation that you had already done in the past is good enough. Prepare journal entries for the year ended 31st March 2020 and the year 2021 according to Ind AS 21. Tax rate is 30%. Okay, tax rate is also given. Now, why will they give you the tax rate? That is something that we are wondering over here. You are going to do upward revaluation of your machinery. This revaluation will not be recognized for income tax. Understand? Your tax base will turn out to be different from the carrying amount of the asset in your books. This will give rise to temporary difference. And on temporary difference, you will have to recognize deferred taxes. Okay, really interesting one. They wish that we record journal entries. Okay, let us understand what can be the scheme of the journal entries. We start with the transaction date, 30th January 2020. You are acquiring a machinery. I can say PP account debit, isn't it? And we are getting it from a US supplier on credit basis. Hence, I say to supplier account. Okay, it is $5,000 and the rate is 60 rupees. I will record this accounting entry at 3 lakhs of rupees. My first accounting entry will be at rupees 3 lakhs. Right. Then on 31st March 2020, we are doing revaluation of the machinery. Okay, what can be my next accounting entry? 31st March 2020. We can record for the revaluation, and you can also record for the translation of the supplier. See, PP over here is a non-monetary asset, but the non-monetary asset, we are following the revaluation model. So I have to work out what is its value on 31st March 2020. And the supplier that you are showing here, okay, this supplier will turn out to be a monetary item. It's a liability to be settled in cash. That is the reason it's a monetary item. Monetary item should be translated at the closing rate. They have given you the closing rate now as 65. Okay. So I will say here that earlier the supplier was recorded at 60. Now it will be recorded at 65. Value of the supplier will increase. I will say to supplier account, see, it will be $5,000 now at 65. 5,000 at 65. That is 3,25,000, and the earlier recorded was 3 lakhs, isn't it? So this will turn out to be 25,000. Your supplier is increasing, your liability is increasing, hence it is a loss. This exchange difference, which is representing a translation loss, will be debited to the profit and loss account. We know that translation differences for monetary items, unless and until it is falling in the case of exception, you are supposed to recognize in the P&L. Hence, I will say profit and loss account debit. Right, I'll record this accounting entry for 25,000. Hope you are comfortable, right? The supplier, that is a liability, is increasing. Increase in value of liability will be a loss. So P&L should be debited. We are doing translation of the monetary item at the closing rate. Apart from that, the machinery also has to be revalued. Okay, machinery is required to be revalued. Okay, let me do that also. This will be also done on 31st March 2020. It will be PP account debit. You are recording this at $5,500, $5,500, and the rate is 65 now. Okay. You are doing revaluation on 31st March, and on 31st March 20, the rate is 65. I multiply that by 65. So that is turning out to be 357,500. You have already recorded the PP at 3 lakhs to revaluation reserve account. Okay, this will be my accounting entry. PP account debit to revaluation reserve account. I will say it is 57,500. We are doing upward revaluation of the plant and machinery, and it is 57,500. PP to revaluation reserve. If you wish, you can write in brackets OCI, other comprehensive income, right? So on 31st March 2020, the first thing that I am doing over here is I am recognizing the translation loss for the supplier. I am recording for the revaluation of the plant and machinery. If you read the question, they haven't given us any information by which we can determine the depreciation. No useful life is given, no rate of depreciation is given, nothing is given. So I will not be able to calculate anything with respect to the, what we can say, depreciation. But they have given me the tax rate. Okay. Tax rate is given. Understand what is happening for this item of PPE. Please understand, for the item of PPE, your carrying amount of the item of PP, the latest, it is 3,57,500. This we have to compare with the tax base. Tax base, because nothing is given, I am considering the tax base as the cost. The historical cost is 3 lakhs. This will give rise to temporary difference, right? Temporary difference is 57,500. That is nothing but the revaluation surplus that you have recognized. Carrying amount of asset is greater than the tax base. When the carrying amount is greater than the tax base, it gives rise to taxable temporary difference. This temporary difference that you have is a taxable temporary difference. On taxable temporary difference, you should recognize deferred tax liability. I will recognize DTL 57,500 and the rate is 30%. The amount of deferred tax liability is turning out to be 17,250. I should recognize a deferred tax liability of 17,250. Okay. 17,250. This will be further, right? This will be the third accounting entry that we will record on 31st March 2020. Deferred tax liability is recognized. I say to deferred tax liability, right? It's a liability. It will have a credit balance. What will I debit? This deferred tax liability is based on a taxable temporary difference, and taxable temporary difference is caused on account of revaluation gain. Revaluation gain will be recognized in OCI. Hence, this accounting entry will be also recognized in OCI. You have transferred the revaluation gain to revaluation reserve. So revaluation reserve account will be debited. Hence, I say revaluation reserve account debit. Okay, this will be recorded at 17,250. Remember, it is getting recognized in the OCI. Revaluation surplus will be recognized in OCI, and on that revaluation surplus, whatever DTL you are recognizing, that will be also routed through the OCI. Revaluation reserve will be credited by 57,500. Revaluation reserve will be debited by 17,250, representing a deferred tax liability. Okay. What more? Yes. Finally, we are going to settle the payment on 31st March 2021. Okay, 1 year from now, 31st March 2021, you will settle it. At that time, the rate will be 67. Okay. At that time, the rate will be 67. So on 31st March 2021, I will again say profit and loss account debit to supplier account. Okay. $5,000 are to be paid, but the rate is 67 now. 5,000 into 67. That is turning out to be 3,35,000, and we have already recorded it up to 3,25,000. So from this, I will deduct 3,25,000. There is a further translation loss of 10,000, which will be debited to the profit and loss account. Right, 10,000 will be debited to the profit and loss account. And then I will make the final payment. Okay, we will make the final payment on 31st March 2021. We will say supplier account debit. See, the supplier is actually now 3,35,000. And we say to bank account. Okay, we make the payment 3,35,000. This is the final payment that we make, which will settle our USA supplier. If you wish, these two accounting entries can be merged and can be recorded as a single accounting entry. That is also possible, right? You can even do it in that way as well. In that case, it will be supplier account debit 3,25,000. Profit and loss account debit 10,000 to bank account 3,35,000. You know, you can record a combined accounting entry. That is also possible. Combined accounting entry. Instead of recording two accounting entries, you can record a combined accounting entry. It will look like this: combined accounting entry. Supplier account debit. It was till now translated at 3,25,000. profit and loss account debit. This is the further translation loss of 10,000 to bank account 3,35,000. This is also possible. I have recorded the translation loss and the final payment separately, but you can always combine the two and record a single accounting entry. That is also very much possible. Here it is. If I just give you a view again, this is on 30th January 2020. Your eyes on this, right? Here it is, the answer. Revaluation model is followed because fair value is given. That is the reason. Just see your first accounting entry. Just tally with what you have already have as a solution. Plant and machinery account debit or PP account debit to supplier account 3 lakhs of rupees, isn't it? Right, then we are recording for the translation loss. Here it is, translation loss of 25,000. Loss of 25,000. P&L account debit to supplier account 25,000. Then we have to work out the latest value of the plant and machinery 5,500. Here it is in our answer, right? 2, the second one. I'm referring to this. This is what we have done. 57,500 PP to revaluation reserve 57,500. We are referring OCI over here, okay? And then you have to also recognize the deferred tax liability. Here it is. I've shown the entire working, how we calculated the deferred tax liability. This is the working that I have shown. Carrying amount is asset is greater than the tax base of the asset. This gives rise to taxable temporary difference. Recognize DTL. This is how I calculated 17,250. That's the accounting entry here. Revaluation reserve account debit OCI to deferred tax liability 17,250. And this is those final 2 accounting entries which I was saying you can merge and record even a combined accounting entry over here. P&L to supplier 10,000, 10,000, supplier to bank 3,35,000, or record a single accounting entry. Here it is. This is where I have shown the workings, right? This is here. What is there on the screen is what I am referring to. P&L to supplier, supplier to bank, that's there in our solution. If you are of the view that why to record 2 accounting entries, fine, you can record a single accounting entry. I've put it on the side. You can see on the left hand side, supplier account debit, profit and loss account debit to bank account, isn't it? That's it over here. 10,335. Combined accounting entry. I'll again show it. Here it is. Hope you are comfortable with the solution. It's the end of our answer. Suggest treatment based on Ind AS 21. Functional currency of parent P is Euro, while the functional currency of its subsidiary S is USD. You have parent P and it has a subsidiary S. Here the functional currency is Euro, while here the functional currency is dollar. Okay. P sells inventory to S and a transaction for the same was made for USD 300 during the year. At the year end, a balance of the same amount is outstanding as receivable from S. It has been observed that such balance amount has been continuing as receivable from S year on year, and even though the payments in respect of these balances are expected to be received in the foreseeable future, but we look at the year end, then we see this balance as outstanding every year. Okay, the parent has made a sale to the subsidiary, certain amount is recoverable from the subsidiary, but the subsidiary has still not made any payment with respect to the same. Year on year, the amount is remaining outstanding. That is what they are saying. Then they say, in addition to the trading balance between P and S, P has lent an amount of USD 500 to S that is not expected to be repaid in the foreseeable future. Should exchange difference be recognized in profit and loss? Apart from this, there is another transaction as well. P has lent. Okay, there is a loan transaction over here of $500, and they are saying it is not expected to be repaid in the foreseeable future. So what is happening over here is, one, you are having an outstanding receivable, another you have an outstanding loan. Now outstanding receivable is a monetary item and the loan is also a monetary item. Monetary item should be translated at the closing rate, and the exchange difference should be recognized in the profit and loss account, except if the monetary item falls under an exception. And what is the exception? The monetary item may be a part of, remember this, monetary item may be a part of net investment in the foreign operation. If it is a part of net investment in foreign operation, then the exchange difference recognition is slightly different. Perhaps that is what they are trying to say in this particular case. First, they are saying that, see, parent P had made a sale to the subsidiary. Years and years have gone by, but 300 USD is remaining outstanding. Apart from that, the parent has given a loan which is not expected to be repaid in future. Can we consider these two items as monetary items forming a part of net investment in foreign operation? If you say it is a part of the net investment in foreign operation, then whatever is the exchange difference, it will be recognized in P&L in separate financial statements. But that same exchange difference will be recognized in OCI in consolidated financial statements. Are we supposed to give that special treatment? Yes or no? That's the question all about. Yes, I will take you to our write-up for the same, the net investment in foreign operation, the exception. Here it is. Right, net investment in a foreign operation. See. They say a monetary item receivable from or payable to a foreign operation forms part of the net investment in a foreign operation if the settlement of the monetary item is neither planned nor likely to occur in the foreseeable future. But read it now. Such monetary items may include long-term receivables or loans, but do not include trade receivables or trade payables. When you say that this is a monetary item forming a part of the net investment in foreign operation, remember this, long-term receivable can be considered to be a part of the net investment in foreign operation. A long-term loan can also be considered to be a part of net investment in foreign operation if it is not likely to get settled in the foreseeable future. However, any balances which are resulting on account of trading activities, as you can see, it does not include trade receivables or trade payables. Even if the trade receivable is remaining continuously outstanding, even if the trade payable is remaining continuously outstanding, it can still not become a part of net investment in a foreign operation. I believe that makes this case really simple now, because we are having two items over here, isn't it? You are having a trade receivable. The trade receivable is of USD 300. Trade receivable of USD 300 will not become a part of net investment in foreign operation, and hence for 300, whatever are the exchange differences, it should be recognized in the P&L. Apart from that, you also have a loan, right? It has lent a loan of USD 500, and they are saying it is not expected to be repaid in the foreseeable future. This is a long-term loan. This long-term loan can become a part of the net investment in foreign operation. What shall you do then? When you prepare separate financial statements of parent P, recognize any exchange loss or gain arising on this item in P&L. But when you prepare consolidated financial statements, parent and subsidiary is a single company. You cannot lend to yourself and have a translation gain or a translation loss. Hence, translation gain or translation loss in CFS, consolidated financial statements, should be recognized by creating a separate reserve. You may create a foreign currency translation reserve and you can transfer it to foreign currency translation reserve. The moment you say it is foreign currency translation reserve, that means it is recognized in equity as a part of other comprehensive income, right? Let's read the answer. They are saying the exchange gain or loss will arise in the books of accounts of P in respect of trading balance with S, and the same should be recognized in profit or loss, right? Balances, outstanding balances arising out of trading activities, basically trade receivables and trade payables, even though they may remain continuously outstanding year after year, they still do not become part of net investment in foreign operation. This being a balance for in the nature of trade receivable, it would not be considered as net investment in foreign operation. The amount lent by P should be regarded as net investment in foreign operation. Thus, the exchange gain or loss incurred by P on $500 loan should be recognized in profit or loss in separate financial statements and in other comprehensive income in consolidated financial statements. In CFS, recognized in OCI. In separate books, recognized in the P&L. Modifying the above illustration, suppose that for tax reasons, the permanent funding extended to S is made via another entity in the group T rather than from P directly. That is on the directions of P, T gives a loan to S. T is also a subsidiary of P. Where would the exchange difference be recognized? They are saying that you have parent P, then you have subsidiary. Now you have two subsidiaries, T and S. And this time T is giving this loan, which is not expected to be settled in the nearby future. They are saying, will your answer change now? Why should the answer change, right? The answer will still remain the same only. Whether parent P is directly funding the subsidiary or parent P is funding the subsidiary S through another subsidiary T makes no difference. As far as CFS is considered, I still have to recognize the exchange difference in OCI. This will still be considered to be a part of net investment in foreign operation, right? Any exchange difference in respect of the loan is recognized in other comprehensive income and consolidated financial statement because from the group's point of view, the funding relates to an investment in foreign operation. This is the case irrespective of the currency in which the loan is denominated, right? Denomination of the loan doesn't matter. The fact of the matter is that parent P has advanced a loan to the subsidiary either directly in the first case or indirectly in the second case. It means you are providing finance, you are infusing capital in the subsidiary. In consolidated financial statements, whatever is the exchange gain or loss for such a loan, it should be recognized in OCI, right? Open something like a foreign currency translation reserve and transfer it over there. Entity A, whose functional currency is INR, has a foreign operation entity B with a euro functional currency. Entity A, it has a foreign operation which is entity B. Functional currency of entity A is INR and the functional currency over here is euro. And what they have done is entity B issues to A perpetual debt, that is, it has no maturity. Entity B, okay, entity B is issuing a perpetual debt. Perpetual debt means it does not have any maturity date, right? They are saying with an annual interest rate of 6%. The perpetual debt has no issuer call option or holder put option. Issuer is entity B over here. Entity B cannot call back this money from entity A. Similarly, entity A cannot return back this money to entity B. That means you do not have, issuer does not have call option. Call option means I can call for refund of this perpetual debt. Call option means a right of buying. Here you can go for a buyback. Buyback means I will ask entity A to return back the money. Holder does not have a put option. Put option is a right to sell. Entity A cannot return back this money to entity B. That makes it very clear that this is turning out to be a loan which is not going to be repaid in the foreseeable future. A loan that is not repayable in foreseeable future will become a part of net investment in foreign operation. And when it becomes a part of net investment in foreign operation, exchange gain or loss on such kind of a loan will be recognized in P&L, in separate or individual financial statements, and in CFS it will be recognized in OCI through foreign currency translation reserve. Okay. Anyways, they are saying thus contractually it is just an infinite stream of interest payment in euros. In AS consolidated financial statements, can the perpetual debt be considered a monetary item for which settlement is neither planned nor likely to occur in the foreseeable future? Our answer will be yes. You can definitely consider it as a part of net investment in B. With the exchange gains and losses been recognized in equity, answer will be yes. Recognizing in OCI is as good as recognizing in equity. Okay. When you will prepare statement of changes in equity, when you prepare SOC, we say part A is equity share capital, balance at the beginning, change during the period, balance at the end, right? And then we say B, other equity. In other equity, I will be showing one reserve as foreign currency translation reserve. That's nothing but becoming a part of the equity. As far as interest is considered, there's no problem. The company which is paying interest will show this as interest paid as an expense, and the company that is receiving interest will show it as interest receivable as an income. We do not have any issue with the interest. Issue is with the principal amount. Although it is a debt, although it is a loan, it is a monetary item, but translation gain or losses of this monetary item will not go straight to the P&L. In separate financial statements, individual financial statements, it will be recognized in P&L, agreed. But when you prepare CFS, it will be recognized in OCI, or we can say recorded in equity. Through origination of perpetual debt, A has made a permanent investment in B. Interest payments are treated as interest receivable by A and interest payable by B, not as repayment of the principal debt. Hence, the fact that the interest payments are perpetual does not mean that settlement is planned or likely to occur. Perpetual debt can be considered part of A's net investment in B. The foreign exchange gains and losses should be recorded in equity at the consolidated level because settlement of that perpetual debt is neither planned nor likely to reoccur. They have not given anything with respect to the separate financial statements, but that can also be made a part of your answer. You can say that the foreign exchange gains and losses will be recorded in the individual or separate financial statements of entity B in P&L. In consolidated financial statements, it will be recorded through OCI, that is in equity. If you have a parent subsidiary relationship, it is very natural that you are going to have intra-group transactions. By intra-group transactions, we mean transactions between the parent and the subsidiaries. Now, elimination of the unrealized profit in these transactions, elimination of the outstanding balances in these transactions is basically a subject matter of Ind AS 110. Right, Ind AS 110 consolidated financial statements. That is the Ind AS which is applicable for elimination of the profits, elimination of losses which have remained unrealized insofar as the group is considered. But then it is also possible that there may be transactions in foreign currency between the parent and the subsidiary. Insofar as the exchange differences are considered for these foreign currency transactions, Ind AS 21 will become applicable. So let us try to understand that if there is an intra-group transaction and there is an exchange difference, whether gain or loss, how it is to be treated. Now, this will depend upon what is the functional currency of the parent and the functional currency of the subsidiary. If the functional currencies of the parent and the subsidiary are the same, then for one company there shall be an exchange gain. Correspondingly, for the other company there shall be exchange loss, and hence the two of them will get set off against each other when you prepare CFS. Because the two will get set off against each other, that is, will get eliminated against each other at the time of consolidation, no further treatment is required. However, having said this, if the functional currency of the parent and the functional currency of the subsidiary are different, then for one company there will be an exchange difference, but for another company there will be no corresponding exchange difference, and hence the exchange difference will not get eliminated. If the exchange difference does not get eliminated at the time of CFS, how should it be treated? That is what we want to discuss now. Let me take an example and explain you what I am trying to suggest over here. Let us say there is a parent and the parent has a subsidiary. This is basically a foreign subsidiary, okay? And the functional currency for the parent is INR, and the functional currency for the subsidiary is also INR. I am dealing with the first case where the functional currency of the parent and the subsidiary are the same. We will take certain figures, and at the end you will realize that when the functional currencies of the parent and the subsidiary are the same, exchange differences get eliminated against each other at the time of CFS, and hence no further treatment is required. Think in this way. Parent sells goods. Okay. Let us say the selling price is $1,000 to the subsidiary. This is the transaction. Parent is selling goods of $1,000 to the subsidiary. Now, because the transaction is in USD will be a foreign currency. Any currency other than the functional currency will become the foreign currency. Now, your functional currency is INR. Hence, parent as well as subsidiary will treat this as a foreign currency transaction. Now, let us say on the date of transaction, the exchange rate is, for simplicity, let's say it is $1 equals to rupees 70. Tell me, how will the parent account for this transaction? Parent will say it will be S Limited. Let us say the subsidiary is S Limited. It will say S Limited account debit to sales, isn't it? And this accounting entry will be recorded at 70,000. $1,000 converted at $1 equals to rupees 70. So we are saying it is 70,000. Okay, what will the subsidiary do? How will the subsidiary record this accounting entry? Subsidiary will say it is purchases to P Limited, right? Let's consider the parent to be P Limited. Subsidiary will also record at rupees 70 a dollar. So this accounting entry will be also recorded at 70,000 rupees. We know that whenever there is a foreign currency transaction, it should be initially translated at the rate existing on the transaction date. We are saying on the transaction date, the exchange rate is 70 rupees a dollar. This is the accounting that will be done in the respective books of parent and the subsidiary. Okay. Now we have 31st March, the day when we are going to finalize our financial statements. On that, the rate is turning out to be $1 equals to rupees 72. Okay, what will happen now? The balances which are outstanding, which is a trade receivable for the parent and the trade payable for the subsidiary, is ultimately a monetary item. Monetary item should be translated at the closing rate. The closing rate will turn out to be $1 equal to 72 rupees. $1,000 will be now translated at 72. Hence, it will become 72,000. What you have recorded at 70, right? S Limited you have recorded at 70. It has to be now updated to 72,000. P Limited, which you have recorded at 70,000, it has to be updated to 72,000. For one company, trade receivable is increasing, asset is increasing. Hence, there is an exchange gain. For the other company, liability is increasing. That is, there shall be an exchange loss. My accounting entry will be, right? I'll say it is S Limited account debit. I'll have to increase it by 2,000 to exchange gain. isn't it? I'll say to exchange gain account and it will be 2000, right? Similarly, what will happen for the subsidiary? For subsidiary P Limited, which is a liability, its balance will increase. Hence, your accounting entry over here will be exchange loss account debit to P Limited, right? You will record this for 2000. I hope you are getting my point. What has happened over here is that now, as on the balance sheet date, the closing rate is 72. The outstanding balances of trade receivables and trade payables being monetary items, they have to be now translated at the closing rate. For the parent, there is an exchange gain, and for the subsidiary, there is an exchange loss. Now see, all these things are fine when you are preparing the separate financial statements or individual financial statements. But when you will prepare CFS, right, these items will get offset against each other. Try to visualize now a scenario of consolidated financial statements. Let's say you are preparing consolidated P&L. Okay, when you will prepare consolidated P&L, right, consolidated P&L, the sales will get offsetted against the purchases. The two of them will get eliminated, right? We will have to eliminate this intercompany transaction. Okay, this outstanding balance of S Limited will get eliminated against the outstanding balances of P Limited. Isn't it? One company will be showing debtors, another company will be showing creditors, but when you will prepare CFS, debtors and creditors will match against each other. It is a mutual obligation, and hence the balance will get eliminated. And not only this, one company is showing exchange gain of 2000, another company is showing exchange loss of 2000. Even this also will get eliminated against each other. That is the reason I was saying that when the parent and the subsidiary have a common functional currency, when they have same functional currency, exchange gains and exchange losses will get offsetted against each other. In CFS, they will get eliminated against each other, and hence no further treatment is required. Okay. So that was the case over here. We are saying, is the functional currency of parent and subsidiary the same? Answer is yes. Remember, read this. Yes, foreign exchange gains or losses will be eliminated against each other in CFS. No further treatment is required. Right. But what if the functional currencies are different? Yes. What if the functional currencies are different? Let us revisit the illustration. Let us say you have a parent and the parent has a subsidiary. Okay. For the parent, the functional currency is INR. For the subsidiary, the functional currency is US dollar. Okay. P Limited. Consider P Limited as the parent company. It sells goods worth $1,000 to S Limited. Consider S Limited as the subsidiary. P Limited is the parent, S Limited is the subsidiary. You are selling goods worth $1,000. Okay. Now on this particular date, the exchange rate is 70 rupees a dollar. How will you record the accounting entry in the books of P Limited? For P Limited, INR is the functional currency while the transaction is in USD. For P Limited, this is a foreign currency transaction which needs to be translated at the rate prevailing on the transaction date. Hence, P Limited will record the accounting entry S Limited account debit to sales account. To sales account, right? This accounting entry will be recorded at 70,000, right? At rupees 70,000. What about S Limited? For S Limited, the functional currency is dollar and the transaction is also in dollar. So where is the question of any translation over here, right? What the subsidiary will do is subsidiary will record the accounting entry. Yes. Purchases account debit. Just a second. Yes, it will record the accounting entry. Purchases account debit to P Limited. And it will record this accounting entry at $1,000. For S Limited, this is not a foreign currency transaction. Foreign currency means currency other than functional currency. My functional currency is dollar, and my my transaction is also in dollar. So I have to simply say purchases to P Limited $1,000. Isn't it? Now let us say you are going to finalize your books on 31st March. On 31st March, the rate now is 72. The rate now is 72. This S Limited that you are showing over here, it is a trade receivable. It's a monetary item. Monetary item will be translated at the closing rate. Hence, I will have to carry out the translation. What will be your accounting entry for the translation? The accounting entry for the translation will be S Limited account debit to asset is increasing, and hence I will say to exchange gain account. This accounting entry will be recorded for 2,000 rupees, isn't it? 70,000 has to be now updated to 72,000, and hence there is a gain of 2,000, right? But, and that is really important, here no effect is required to be given. You have recorded at $1,000, understand? You have recorded at $1,000. Now, if the exchange rate is going up or down, the value of dollar in dollar will remain the same only. Hence, I do not have to record any exchange gains or losses in the books of the subsidiary. Getting it? Okay. Now we are preparing the consolidated financial statements. Just see, you are preparing consolidated P&L. What will happen in consolidated P&L? The sales and the purchases will get offsetted against each other, right? Of course, at that time you will carry out the translation of the purchases, and the two will get offset against each other in the statement of profit and loss. Similarly, the balances of S Limited and P Limited will get eliminated against each other. S Limited is supposed to pay $1,000 on 31st March, and the value of $1,000 on 31st March is 72,000. Hence, the two will get offset against each other. You are still left with exchange gain. There is nothing over here, right? There is nothing like a corresponding exchange loss which was there earlier. Hence, you are left with exchange gain. This exchange gain has to be recognized in the consolidated financial statements. Getting it? When you prepare CFS, this exchange gain will be transferred to profit and loss account. In CFS, I will transfer it to P&L. Unless and until it is a monetary item which is forming part of net investment in foreign operation. That you already know. If it is a part of the net investment in foreign operation, yes, then when you prepare CFS, it will be recognized initially in OCI by transferring it to foreign currency translation reserve. But here we know it is a trade receivable. Trade receivables and trade payables do not become part of net investment in foreign operation, and that is the reason I can safely say that this amount should go to profit and loss account. Comfortable? And yes, in case if you are wondering that how the sales and purchases, see, please understand. Sales is recorded in INR, but when I will prepare the CFS, at that time, the foreign operation will get translated, right? When foreign operations will get translated, this $1,000 will be translated. So that is the reason the sales and purchases ultimately will offset against each other. Obviously, 70,000 rupees will not get offsetted against $1,000. $1,000 will be converted into what is its INR equivalent, and then the two will be offsetted. Similarly, the S Limited and P Limited's outstanding balances will be offsetted against each other. But exchange gain will not get offsetted because there is no corresponding exchange loss, unlike the earlier case when the functional currencies were same. And that is the reason I have to give treatment for this exchange gain. That's the case here. The second one. Foreign exchange gains or losses will not be eliminated against each other in CFS when the functional currency of the parent and subsidiary is not the same. What to do with that exchange gain or losses then? Recognize in profit and loss. Unless it arises from a monetary item that forms part of a reporting entity's net investment or foreign operation, in which case it is taken to OCI. That we have already discussed earlier, isn't it? That if there is a monetary item For example, the parent has given a loan to the subsidiary and there is not going to be any repayment in the foreseeable future, then we can consider this to be a monetary item forming part of the net investment in the foreign operation. Yes, at that time in CFS it will go to OCI, but trade receivables and trade payables, they will never form part of monetary, they will never form part of net investment in foreign operation. Okay. And one more thing, whenever you are doing intercompany transactions, there can always be a point of unrealized profit. See, this will be irrespective of whether the functional currencies are same or functional currencies are different. When parent is selling to the subsidiary, there might be some portion of profit. If the subsidiary is not selling it to a third party, then the profit will remain unrealized. That unrealized profit still has to be eliminated. That will be done as per Ind AS 110. Getting it? Although purchases will get offsetted against the sales, the outstanding balances will get offsetted against each other, but whatever is a part of the inventory which is representing unsold goods that you have purchased within the group, there can be unrealized profit. Following Ind AS 110, you have to eliminate the unrealized profit. By chance it is unrealized loss, then unrealized loss should also be eliminated. So that is a general note that we have over here, that at the time of consolidation, unrealized profit losses are eliminated for goods lying in stock or items of PP, intangible assets held within the group as per the requirements of Ind AS 110. Unrealized profit will not be eliminated as per Ind AS 21. It is getting eliminated as per the main accounting standard that considers the main accounting standard that requires how consolidation is to be done, and that is Ind AS 110. The functional and presentation currency of parent P is USD, while the functional currency of its subsidiary S is Euro. P sold goods having value of USD 100 to S when the exchange rate was USD 1 is equal to 2 euros. At the year end, the amount is still due and the exchange rate is USD 1 equals to Euro 2.2. How should the exchange difference, if any, be accounted for in the consolidated financial statements? Okay. You are having parent P and it has a subsidiary S. Functional currency is USD and the functional currency here is the Euro. And now what P has done is P has sold goods having a value of $100 to S, right? P will record in its books, this will be S Limited account debit to sales. It will happen in dollars, 100 and 100. But what about S Limited? S Limited will record this as purchases to P Limited, right? Now for S Limited, the functional currency is Euro, but the transaction is in dollar. It will have to record this in Euro. On the date of transaction, the exchange rate is USD 1 equals to Euro 2. Hence, this will be recorded as 200 and 200 in euros. Now, at the year end, the exchange rate now is USD 1 equals to Euro 2.2. As far as parent is considered, there will be no effect. Parent's functional currency is dollar, so it has already recorded the transaction in dollar, so it does not have to do any translation. But the subsidiary will have to carry out a translation, isn't it? Now the rate is 2.2. You have recorded this P Limited at 200. The outstanding to P Limited is representing a trade payable. A trade payable is a monetary item and hence it has to be translated at the closing rate. Okay. So what will happen is you will have to record this now at 2.2. So instead of 200, you have to now record this as 220. So there shall be an exchange loss now. On 31st March, there shall be exchange loss account debit to P Limited and it will be Euro 20. Okay, it will be Euro 20. Now what will happen in consolidated financial statements? Okay, In consolidated financial statements, these outstanding balances will be getting set off against each other. After all, S Limited is saying that $100 is recoverable from the subsidiary, and the value of $100 right now is 220 euros. So the two are getting set off against each other. Sales and purchases will get set off in the statement of P&L. Of course, the purchases which are in euro has to be translated into dollar, and then the two will be set off. Problem is with this exchange loss of 20, we are not having any corresponding exchange gain in the books of the parent. So this exchange loss will be required to be recognized in consolidated financial statement. Because this item is a trade payable, it will not form part of net investment in the foreign operation. And hence, this exchange loss will be debited to the profit and loss account in the CFS. At the year end, S showed restated accounts payable at euro 220, recognizing a loss of euro 20 in its profit or loss. Thus, in the books of S, the balance payable to P will appear at euro 220, while in the books of P, the balance sheet receivable will be 100. For the consolidation purpose, assets and liabilities will be translated to USD at the closing rate. At the time of consolidation, USD 100 will get eliminated against the receivable in the books of P, but the exchange loss of 20 euros recorded in the subsidiary statement of P&L has no equivalent gain. Just a second. Yeah, sorry for that. What we were suggesting is that at the time of consolidation, $100 will get eliminated against the receivable in the books of P, but the exchange loss of 20 euros recorded in the subsidiary statement of P&L has no equivalent gain in the parent's financial statement. Therefore, euro 20 will remain in the consolidated profit and loss account. Right? You will have to debit the consolidated P&L with this particular loss. M Limited is engaged in the business of manufacturing of bottles for pharmaceutical companies and non-pharmaceutical companies. It has a wholly owned subsidiary G, which is engaged in the business of pharmaceuticals. G Limited purchases the pharmaceutical bottles from its parent company. The demand of G Limited is very high and the operations of M Limited are very large, and hence to cater to its shortfall, G Limited also purchases bottles from other companies. Purchases are made at competitive prices. Okay. So far what we realize is that you have a company M Limited, and this company M Limited has a subsidiary G Limited, and they seem to be doing transactions with each other. Okay. M Limited sold pharmaceutical bottles to G Limited for euro 12 lakhs on 1st February 2021. The cost of these bottles was 830 lakhs in the books of M Limited at the time of sale. At the year end, that is 31st March 2021, all these bottles were lying as closing stock with G Limited. What should be the accounting treatment for the above? Euro is the functional currency of G Limited. Okay. For G Limited, the functional currency is euro, while Indian rupee is the functional currency of M Limited. For M Limited, the functional currency is INR. And then following additional information is given, and we are given the exchange rates on the date of transaction and at the end of the year. Okay. If you read this para, they are saying that M Limited sold pharmaceutical bottles to G Limited. Okay. M sells to G, and it is euro 12 lakhs. Okay. For M, the functional currency is INR. Hence, M will have to record this in Indian rupees. Okay. Tell me, what will be the accounting entry in the books of M? Right. Money is recoverable from G Limited. So I will say G Limited account debit to sales account, isn't it? To sales account. 12 lakhs euro. This 12 lakh euros should be translated at the rate existing on the date of transaction, which is 83. 12 into 83, I will record this transaction rupees 996. At 996 lakhs, this transaction will be recorded in the books of M Limited. And when the year will come to an end, the exchange rate is 85. The outstanding balance from G Limited is a trade receivable, and this trade receivable will be required to be translated at the closing rate. The closing rate is 85. So this is the accounting entry that I am recording on 1st February. Sorry, not 1st January. It will be 1st February. This is the transaction that I am recording on 1st February 2021. And then on 31st March 2021, it will be G Limited account debit. I will have to translate at 85 now. So euro 12 into 85. 12 into 85 is turning out to be 1020, and we have already recognized it at 996. So I will deduct 996. Okay. So 24 lakhs of rupees will be there, and this will be the exchange gain, which will be recognized in profit and loss account. So 24 is going to be recognized in the profit and loss account. This will be the accounting in the books of the parent company M Limited. Here it is. 1st February 2021, you are recognizing 996. 12 lakh euros will be translated at the rate existing on the date of transaction. And then you'll have to do the translation of the trade receivable, which is an asset. It's a monetary item. I will translate it at the closing rate. Hence, I am getting 24 over here. In exchange difference on translation of the monetary item. Right. So that will be the journal entries in the books of the parent M Limited, where the functional currency is the INR. Things will be relatively simpler in the books of the subsidiary. Okay, the things will be simpler in the books of subsidiary. For subsidiary, the functional currency is euro and the transaction is also in euro. Hence, the subsidiary on 1st February 2021 will record the accounting entry purchases account debit. Okay, purchases account debit to M Limited. And it has to record that in euro. I will record this at 12 lakh euros. And on 31st March 2021, I am not supposed to do any translation. My outstanding is in euro and my functional currency is also euro. Hence, I do not have to record any further accounting entry. You see the journal entries in the books of G Limited. Purchases account to M Limited 12, and do not worry about M Limited. You are not supposed to do any translation over there. It is already in the functional currency, which is euro. So on 31st March 2021, unlike the earlier, I do not have to do any further accounting. Okay, when you will prepare the CFS, what will happen? Okay, when you will prepare the CFS, these outstanding balances will get set off against each other. In the statement of P&L, sales and purchases will get set off against each other, right? But this item which you have debited to the profit and loss account will remain debited to the P&L because there is no corresponding gain in the books of the subsidiary. So let this remain debited to the P&L as it is, right? Apart from this, there can also be unrealized profit. Now there is a information, they say that at the year end, that is 31st March 2021, all these bottles were lying as closing stock with G Limited. Parent has sold to the subsidiary, but subsidiary has still not sold to a third party. Till you do not sell to a third party, your profit will remain unrealized.
Following Ind AS 110, now we are not following Ind AS 21. Okay, following Ind AS 110, you have to eliminate the unrealized profit. I need to work out what will be the unrealized profit now. Okay, let us understand the unrealized profit now. We know that inventory is valued at lower of, right? It will be at lower of cost or the net realizable value, isn't it? Now, as far as cost is considered, we have sold goods worth 12 lakh euros. So at the date of transaction, it is 83. And here it will be 12. And in the date of transaction, the exchange rate is 85. I just want to know what will be the value of these bottles, which is a part of your inventory now, as on the balance sheet date. 12 into 83. It is turning out to be 996 over here, and 12 into 85, it is turning out to be 1020 here, right? This is basically rupees in lakhs. The inventory in INR is at cost 996 lakhs and at NRV 1020. Inventory will be valued at lower of the two. Lower of the two is 996. Inventory is valued at rupees 996 lakhs. Okay, 996 lakhs. Now in this 996 lakhs, whatever is the profit element, that profit has to be eliminated. Go back to the question. Go back to the question. See, read this information. They say the cost of this bottle was 830 lakhs in the books of M Limited at the time of sale. What does that mean? It means, again, I just lost it. They say cost of this bottle is 830 lakhs in the books of M Limited at the time of sale. Bottles, that is goods costing 830 lakhs, right now are valued at 996 lakhs. You get my point? It is valued at 996 lakhs. So I consider over here the cost, which is 830 lakhs. From 996, I deduct 830. I am getting 166 lakhs. There's 166 lakhs. Just a second. We were over here, inventory 996 lakhs. Its cost is turning out to be 830 lakhs. This is giving me a profit of 166 lakhs. This profit of 166 lakhs is the unrealized profit. Okay, this unrealized profit of 166 lakhs is required to be eliminated. How will you eliminate it? Inventory is an asset. The value of the inventory is to be reduced, so inventory will be credited and the consolidated P&L will be debited. My accounting entry will be consolidated profit and loss account debit to inventory 166. I will eliminate 166 lakhs worth of unrealized profit at the time of preparing the CFS. Yes, this is the accounting treatment. In the consolidated financial statements, receivable and payable in respect of the sale and purchase will get eliminated. We are valuing the inventory 996 lakhs 1020. Lower of the two, right? Lower of the two will be considered. So that is turning out to be 996 lakhs. And then they themselves said that cost of these bottles is 830 lakhs. Hence from 996 we are deducting 830. And we are getting an unrealized profit of 166. See, M Limited is selling to the subsidiary, parent is selling to the subsidiary and booking a profit of 166 lakhs. In separate books of parent, you can recognize this profit. But when you prepare consolidated financial statement, parent and subsidiary are considered to be a single company. You cannot sell to yourself and book profit. That is the reason this 166 lakhs as unrealized profit eliminated. So this is the accounting entry that you will record in your consolidated books. Consolidated profit and loss account debit by the amount of the unrealized profit to inventory. Reduce the inventory by 166 lakhs.
Okay, let's understand how we can carry out translation of foreign operations and also translation from functional currency to presentation currency in case if the two are different. Fortunately, the accounting for both of them is the same under Ind AS 21. The principles that we are going to follow are the same. Now you may wonder that earlier also we had discussed the translation requirement. So what exactly is the difference? See, earlier we had seen a 4-step guide, isn't it? The first step was that whenever you are doing a foreign currency transaction, it should be recorded at the rate prevailing on the date of transaction, and averages can also be used if the exchange rates are stable. Then the second step was to classify the items into monetary and non-monetary items. And then the third step was to carry out translation on the reporting date. Monetary items subject to certain exceptions was getting translated at the closing rate, or we can say the rate prevailing on the reporting date. And the non-monetary items were normally not translated. They will be continued at the historical rate. Of course, in both the cases, exceptions were there. And finally, the step 4 was that if there are any exchange differences, again subject to certain exceptions, they should be recognized in profit and loss. Earlier, we had seen translation requirements. Again, Ind AS 21 is saying translation. Now they are saying translation of foreign operation, or altogether another situation where you are translating from foreign currency to presentation currency. I will like to really understand the difference between the two first. Okay, these new principles we will definitely discuss. But before everything else, it should be clear that when shall we apply the earlier guidance of translation and when are we supposed to apply the guidance that we are now going to discuss. Okay. Understand it in this way. Let us say you have a company A Limited, and this company A Limited has a foreign subsidiary, let us say B Limited. Okay. A Limited's functional currency is INR and B Limited's functional currency is USD. Think about this kind of a situation. Now, A Limited will be doing its own transactions. After all, it's a separate company, and B Limited, which is a foreign subsidiary, will be doing its own transactions. Because it's a foreign subsidiary, we can also say that this is a foreign operation. Okay, foreign operation will include a subsidiary, associate, joint venture, and even a simple branch. Even that also can be considered to be a foreign subsidiary. Okay, now let us say A Limited is doing any transaction independently. Okay, A Limited is doing any transaction in USD, or it is doing transaction in GBP, or it is doing any transaction in Euro, or for that matter any other currency other than the INR. We know foreign currency is a currency other than the functional currency. Functional currency of A Limited is INR. It is doing a transaction in dollar, pound, euro, yen, maybe any other currency. For A Limited, these are all foreign currency transactions. Okay, these are all foreign currency transactions. When you are incorporating this in the books of A Limited, you will follow the earlier 4-step guide. Are you getting me? When these transactions which are in foreign currencies, these foreign currency transactions are to be recorded in the books of A Limited. Because A Limited's functional currency is INR, these foreign currency transactions have to be recorded in the books of A Limited at INR. How to translate these transactions? Here you will apply the 4-step guide that we had discussed earlier. Okay, follow the 4-step guide over here. Comfortable? Okay. Let us say B Limited. Okay, B Limited. It is doing a transaction in euro. It is doing a transaction in pound, or let's say for that matter, it is doing a transaction in INR, in Indian rupees. Okay. Now for a B Limited, the functional currency is dollar. Any currency other than the functional currency will become foreign currency. Okay. Now these transactions also have to be recorded in the books of B Limited. When these transactions are to be recorded in the books of B Limited, you will apply the 4-step guide that we had discussed earlier. Getting it? When a company is independently doing transactions in a currency other than the functional currency, those transactions are foreign currency transactions. Foreign currency transactions are to be translated in our books by following the 4-step guide that we had discussed earlier. Comfortable? At none of these places you are going to apply whatever new that we are going to discuss. Yes, once all these things are completed, please understand, once all these things are completed, B Limited's financial statements will be ready. Okay, B Limited's financial statements, its P&L is ready, its balance sheet ready. After all, B Limited is a foreign subsidiary. It is located in USA. It will have to follow the rules and regulations of USA, and following that, it will prepare its own financial statements. These financial statements obviously will be in USD. Now, A Limited is an Indian parent. A Limited has to now carry out consolidation. And when you carry out consolidation, the foreign subsidiaries' financial statements are now required to be incorporated as a part of the CFS. Okay, this is where the new guidance will become applicable. Financial statements of B Limited are now to be translated to INR. You get my point? This is now translation of foreign subsidiary. Foreign subsidiary which has already prepared its financial statements in USD. Now it has to be incorporated as a part of the CFS exercise of the Indian parent. At that time, whatever figures are there in the financial statements of B Limited in dollar, it is required to be converted into INR. And that's where we will apply the new guidance that we are just going to understand. I hope you are first comfortable with when are we going to apply this new guidance, right? Whatever 4-step guide that you had studied earlier, that has to be followed. If you will try to understand this entire illustration that we have taken over here, you will be applying more of 4-step guide and less of what we are going to discuss now. Throughout the year, you will be doing transactions. Throughout the year, there will be foreign currency transactions. These foreign currency transactions have to be recorded in my books in my functional currency. Every time I will apply the 4-step guide only. Only thing is that once the financial statements of the foreign operation are complete, now they have to become an integral part of the financial statements of the main reporting entity. At that time, this new guidance will be applicable. Getting it? So following this 4-step guide, B Limited has prepared its balance sheet. Let's say it has prepared its balance sheet. In its balance sheet, now it is showing assets and liabilities, right? It is showing assets and liabilities in USD. But A Limited is preparing its financial statements, CFS, let's say consolidated financial statements in INR. Hence, those USD figures have to be now converted into INR. At this particular stage, the new guidance that we are going to discuss now shall become applicable. Okay. So we are discussing something like this. A Limited, which is the Indian parent having a functional currency of INR. It has a foreign subsidiary, B Limited, which functional currency is USD. B Limited's financial statements are in USD. These financial statements in USD are to be translated into INR so that it can become a part of the CFS, consolidated financial statements of the Indian parent. So this translation is required to be done. Here is where you will apply the new guidance that we are going to discuss now. I hope you are comfortable with this, right? Okay. Let us see what those new guidance are. The translation is carried out as under, let's understand the translation. Assets and liabilities translated at the exchange rate at the reporting date, popularly known as the closing rate. Whatever assets are there in the balance sheet of the foreign operation, whatever liabilities are there in the balance sheet of the foreign operation, everything should be converted at the closing rate. Great. Items of income and expenses, and in case if you are preparing a cash flow statement, then all the cash flows translated at exchange rate at the dates of the relevant transactions. Okay. For example, you have to also translate the P&L. Then in the P&L, whatever sources of income are there, whatever expenses are there, they should be translated at the rate at the date of the relevant transaction. But if that is a bit difficult, then average rates can be used. And there shall be some resulting exchange differences. As you can see, assets and liabilities are getting translated at closing rate. Income and expenses are getting translated at average rate. There is a scope of exchange difference. What to do with this? Resulting exchange difference, they say it is recognized in OCI, in other comprehensive income, and are presented as a separate component of equity. You will show it in OCI. You can show it as a part of foreign currency translation reserve or currency translation adjustment until the disposal of the foreign operation. Whatever exchange differences are there for a foreign operation, you should transfer that to foreign currency translation reserve. That's the popular term. You can even call it as currency translation adjustment. Initially, it will be recognized in OCI. Yes, from OCI, it will get reclassified to the P&L as and when the foreign operation is disposed of. Yes, in foreign currency translation reserve, there will be certain other items also. We have discussed this earlier also. They say in addition to the exchange differences as stated above, foreign currency translation reserve may include exchange differences arising from loans that form part of parent's net investment in the foreign operation. Right? If you have a monetary item, we are now applying that 4-step guide. If you are having a monetary item which is understood as a part of the net investment in foreign operation, then in separate books, it will go to the P&L, but in consolidated books, it will go to OCI. So that's one more item which will be shown in the foreign currency translation reserve. And yes, if there are any hedge transactions, then as per Ind AS 109 also, it can go to foreign currency translation reserve. One more thing, when you are acquiring a foreign operation, especially a subsidiary, it can give rise to goodwill. How to carry out the translation of goodwill? Very simple. We have already seen the guidance, right? Goodwill at the end of the day is an asset, isn't it? And assets are required to be translated at the rate on the reporting date, that is the closing rate. If you are acquiring any foreign operation and on the acquisition of foreign operation, there is goodwill. When you are acquiring a business, you will have to apply business combination, Ind AS 103. When you are computing the goodwill, this particular goodwill will be also translated at the closing rate. Goodwill and any fair value adjustments to the carrying amount of assets and liabilities arising on acquisition of a foreign operation are expressed in functional currency of foreign operation and should be translated at the exchange rate at the reporting date, just as other assets and liabilities of the foreign operation. You have to continue to translate at the reporting date. Do not translate the goodwill on the date of acquisition. Okay, for example, on 1st January, I am acquiring a foreign operation. That means goodwill as an asset is created on 1st January. But when I will carry out the translation will happen on the reporting date, that is 31st March. Hence, goodwill will be translated at the rate on 31st March, irrespective of when the goodwill was created. Getting it? Just like any other asset or liability, we are supposed to apply the closing rate. Global Limited, an Indian company, acquired on 30th September 2021 70% of the share capital of Mark Limited, an entity registered as company in Germany. The functional currency of Global Limited is rupees and its financial year end is 31st March 2022. Right, we are given Global Limited, which is an Indian company. On 30th September 2021, it is acquiring 70% of the share capital. The moment you are acquiring 70% of the share capital, you are basically obtaining control over the business. If you are obtaining control over the business, then it is nothing but a business combination. As per Ind AS 103, it's a business combination. And of course, it is also giving rise to parent-subsidiary relationship. Hence, as per Ind AS 110, you will have to prepare consolidated financial statements. Your subsidiary will be in a foreign country because they are saying it is registered as a company in Germany. That means you are also having a foreign operation. Foreign operations, how they are to be translated, that will be a subject matter of Ind AS 21. So we are having multiple Ind AS getting applied over here. In part 1, they are saying the fair value of the net assets of Mark Limited was 23 million euros and the purchase consideration paid is 17.5 million euros on 30th September 2021. The exchange rates as at 30th September 2021 is 82 rupees a euro and 31st March 2022 is 84 rupees per euro. What is the value at which the goodwill has to be recognized in the financial statements of Global Limited as on 31st March 2022? How much goodwill is required to be shown? Now, first of all, I'll have to work out what is the amount of the goodwill. Goodwill calculation will not happen as per Ind AS 21. Goodwill calculation will happen as per Ind AS 103. Right. In Ind AS 103, we take the purchase consideration, which is representing 70% of the shares that we are acquiring. The remaining 30% is the non-controlling interest whose value has to be determined. As per Ind AS 103, you can calculate the non-controlling interest either on the basis of fair value or proportionate share in the net assets. They haven't given us any fair value, but the fair value for determining the non-controlling interest, but they have given us the value of the net assets. Hence, on proportionate basis, it will be possible for us to work out the non-controlling interest. Let's see how we can really calculate the goodwill over here. Looking at the information in part 1, I will like to first take the purchase consideration. They are saying purchase consideration is 17.5 million. Okay, the figures are in euros and it is in million. To this consideration, we should add the value of non-controlling interest. Remember, everything is happening on 30th September 2021. Okay, this calculation that we are doing is on 30th September 2021. On that date, your consideration is 17.5 million, which I have considered. Now I should work out the value of NCI. I am doing this calculation in terms of Ind AS 103. Please understand that. They haven't given us anything, hence I will value the NCI proportionate to the net assets. The net assets are 23 million. You have acquired 70%, that means 30% is going to be the non-controlling interest. That is giving me 6.9. Let me take a total of the two. I get 24.4. And from this, we should deduct the net assets that we have taken over, which we know is 23. I get 1.4. Difference is positive. That means I'm getting goodwill. Goodwill is turning out to be 1.4 million euros. That's the goodwill. They are saying, what is the value of the goodwill? The goodwill is 1.4 million, but 1.4 million in euros. They are saying at what value it should be included in the financial statements of Global Limited. Okay. Global Limited is an Indian company. If you're an Indian company, then this figure has to be in Indian rupees. Okay. Now that's the interesting thing over here. Okay. This goodwill that you have calculated, please understand. This goodwill has been calculated on 30th September 2021. Right. But we are supposed to prepare our financial statements on 31st March 2022. Should I translate the goodwill? Understand the question. Should I translate the goodwill at the exchange rate prevailing on 30th September 2021? Or should I translate it at the exchange rate prevailing on 31st March 2022? Sorry, I just wrote 21. At 31st March 2022, which exchange rate should I consider? I hope you get my point. Goodwill is determined on 30th September 2021. Now I want to convert this into INR, Indian rupees. Should I use the exchange rate on 30th September 2021 or should I use the exchange rate on 31st March 2022? That's the question. We have already seen earlier the translation of foreign operations, and in translation of foreign operations we have seen that assets and liabilities should be translated at the closing rate, and goodwill is ultimately nothing but an asset, and hence it should be translated at the closing rate. I'll take you to that. Yes, this one. Translation of foreign operations. Okay, translation is carried out as under, and I'm referring to this assets and liabilities over here, translated at the exchange rate at the reporting date. When you are translating the financial statements of a foreign operation, you will not ask this question, that is this asset a monetary item or a non-monetary item. If you say it is a monetary item, then it will be translated at the closing rate, and if it is a non-monetary item, it will be translated at the historical rate. If you will apply that logic over here, if you will apply that logic over here, then goodwill will be understood as a non-monetary asset. And a non-monetary asset should be translated at the historical rate. Because the goodwill is created on 30th September 2021, you will say that we should apply the exchange rate on 30th September 2021. But please remember, you are incorporating the goodwill as a part of translation of foreign operation. Okay, as a part of foreign operation. And when you are translating the financial statements of foreign operation, at that time, goodwill will be considered like any other asset of foreign operation, and it will be translated at the closing rate. So your argument that goodwill is a non-monetary item and hence it should be translated at the historical rate, that argument is incorrect. You must appreciate over here that you are calculating goodwill of your foreign operation. So when you will translate 1.4 million, you are translating an asset of a foreign operation, and assets of foreign operation including goodwill, it has to be done at the closing rate. When you translate the financial statements of foreign operation, at that time we do not segregate assets and liabilities into monetary and non-monetary. Every asset, every liability will be translated at the rate on the reporting date, popularly known as the closing rate. In other words, you are supposed to use the exchange rate on 31st March 2022, including the goodwill. I'll take you to that point also. In this write-up, there is a note at the end, and that is what we are doing over here. They are saying that goodwill and any fair value adjustments to the carrying amount of assets and liabilities arising on acquisition of a foreign operation are expressed in functional currency of foreign operation and should be translated at exchange rate at the reporting date, just as other assets and liabilities of the foreign operation. Very good. Now, what is the rate on 31st March 22? It is 84. So what will happen is your goodwill in INR will be 1.4 into 84. $117.6 million. Rupees 117.6 million. That shall be your goodwill. Here it is, the determination of the goodwill. You can see 1.4 million we have already calculated, but it's in euro right now. And I'll apply 84 and it will become 117.6 million. Yes, time to do part 2 now. Mark Limited sold goods costing 2.4 million euros to Global Limited for 4.2 million euros during the year ended 31st March 2022. The exchange rate on the date of purchase by Global was 83 per euro, and on 31st March 22 it's 24 euro. The entire goods purchased from Mark are unsold as on 31st March 2022. Determine the unrealized profit. That is an intra-group transaction. The subsidiary has sold goods to the parent company, and we are now supposed to eliminate the unrealized profit over here. This elimination of unrealized profit is not happening as per Ind AS 21, it's happening as per Ind AS 110. Okay, subsidiary sells to the parent. Right now there is no problem. Subsidiary and parent are two separate companies. But when you prepare consolidated financial statements, parent and subsidiary is a single company. You cannot sell to yourself and book profit. Right, you can't sell to yourself and book profit, and hence this profit is unrealized. Yes, the moment the parent will sell to a third party, then the profit will become realized. But till the goods are lying within the group, till the goods are lying as a part of the inventory of the group, the profit is unrealized. This unrealized profit needs to be eliminated. Okay. It's a case of inventory, isn't it? I will have to value inventory, lower of cost and the NRV. Okay, it is 4.2 million euros, so 4.2, and when this transaction happened the rate was 83. I should multiply this by 83. NRV 4.2. NRV will be determined on the reporting date. On the reporting date the rate is 84. I'm first carrying out the valuation of the inventory. 4.2 into 83, 348.6. 4.2 into 84, it is 352.8. If you are valuing inventory, then I will select the lower of the two. That means it will turn out to be 348.6. I shall value inventory. Okay, I'm taking now rupees in million. My inventory is 348.6, but this is at the purchase cost of the parent. What about the cost to the subsidiary? The subsidiary has initiated the sale. How much profit has the subsidiary made? They say Mark Limited sold goods costing 2.4 million. Okay, costing 2.4 million. Okay. So here I will now consider the cost. It is 2.4 million. Let me take 2.4 million. And we know that on the date of the transaction, the rate is 83. Hence, I will multiply this by 83. 2.4 into 83, I get 199.2. How much profit has the subsidiary made? The profit made by subsidiary is 149.4. This is the unrealized profit. They are asking us determine unrealized profit to be eliminated. Unrealized profit to be eliminated will be 149.4 million rupees. Consolidated profit and loss account debit to inventory. This should be your accounting entry, and you should eliminate the unrealized profit. Here it is, the valuation which we discussed. We pick up the lower of the two, 348.6, and the cost is 199.2, and that's how we get 149.4. That was what I calculated. Yes, 149.4 million. This is the unrealized profit which needs to be eliminated when you are preparing your consolidated financial statement. Infotech Global Limited has a functional currency of USD and needs to translate its financial statements into functional and presentation currency of Infotech Incorporation. The presentation currency for Infotech, it is turning out to be $. Following is the statement of financial position of Infotech Global Limited prior to the translation. It seems that Infotech Global is a foreign operation of Infotech Incorporation. So we are basically going to do translation of a foreign operation. We have already seen the guidance earlier and we will go through it again. But then this is the financial statements which are given to us, which are in dollars. Property, plant and equipment is given, receivables is given, so is the total assets. Issued capital, as you can see, L dollar figures are already given. So these are the figures that we will consider. Opening retained earnings figure is also given. Profit for the year, accounts payable and accrued liabilities. They say total equity and liabilities. Okay. Relevant exchange rates are given to us. Rate at the beginning of the year, average rate and rate at the end of the year. Part 1 is translate the statement of financial position of Infotech Global Limited into L dollar, which is ready for consolidation by Infotech Incorporation. Share capital and opening retained earnings have been pre-calculated. So those figures are already given, so no need to convert that into L dollar. The rest of the figures are required to be converted into L dollar. When we read part 1, it's becoming clear that we have to translate the statement of financial position. Statement of financial position is nothing but balance sheet of Infotech into L dollar, which is ready for consolidation. This makes it very clear that we are going to translate the financial statements of a foreign operation. When you translate the financial statements of a foreign operation, the guidance given in Ind AS 21 is assets and liabilities will be translated at the rate on the reporting date, that is nothing but the closing rate. Items of income and expenses should be translated at the average rate. Actually, you should be using the rate which is prevailing on the date of transaction, but then that can become quite tedious, and that is the reason. If average rates are given, we can definitely make use of the average rates. Right, this is the discussion that we are going to use, right? The translation of foreign operations. This is what we are doing here, or translation from functional currency to presentation currency. Okay. How will the translation be carried out? These are the broad principles that we are supposed to follow over here. Assets and liabilities, that's the first part, right? Assets and liabilities translated at the exchange rate at the reporting date. Do not segregate assets and liabilities into monetary items and non-monetary items and then argue that monetary items will be translated at the rate which is at the date of the on the date of the reporting date, that is the closing rate, and non-monetary items will be translated at historical rate. No, that is not to be done when you are doing the translation of a foreign operation. At that time, every asset and every liability, irrespective of whether it is monetary or non-monetary, it has to be translated at the rate on the reporting date, popularly known as the closing rate. Okay. Items of incomes and expenses as well as the cash flows translated at exchange rates at the date of the relevant transaction. If that actual rate is given, then use it. If not available, make use of average rates. Okay. Now, because certain items will be translated at closing rate and certain items at average rate, there is bound to be exchange difference. This exchange difference will be recognized in OCI, foreign currency translation reserve, right? You should maintain a foreign currency translation reserve or a currency translation adjustment. But more importantly, it will be recognized in OCI. It can be transferred to the P&L, but only on the disposal of the foreign operation. So that's the guidance that we shall be using over here. Okay. What do you say? Property, plant and equipment, right? Let's start from here. Property, plant and equipment. Assets will be translated at the closing rate. At the end of the year, it is 1.13. I will apply 1.13 over here. Receivables asset translated at the closing rate. Okay, issued capital. See, issued capital figure is already given. Directly take the L dollar figure. Opening retained earnings, it is already given. Directly take the figure which they have given. Profit for the year. Profit for the year will be made out of incomes and expenses for the year, and income and expenses of the year, average rate can be used. What is the average rate? Here it is. 1.175. Accounts payable, that's the liability closing rate. Accrued liabilities closing rate 1.13. This is how the rates will be selected, and we will be converting it into L dollar. Once the figures are converted into L dollar, there can be some exchange difference, and as we've already discussed, exchange difference will be recognized in OCI by making it a part of foreign currency translation reserve. Okay, how shall the conversion take place? Now, if you see here, they are saying $1 equals to USD 1.22. Please understand, USD and $1, $1, right, is equal to 1.22, or let's pick up the last one. Okay, 1.13, let's say 1.13. Now, if you see the first item, PPE, it is 50,000. They are saying 50,000 will be how much? What I am trying to say is that when the USD will be converted to $, you are not supposed to multiply the two. If you are like that 50,000 will be multiplied by 1.13, no, you can see over here, we'll have to do cross multiplication. In other words, 50,000 will be multiplied by 1 and it should be divided by 1.13. Whatever figures are given in dollars, these figures in dollars will be divided by the exchange rate given, and then you will get the $, figures, right? Here it is before you, the translation from functional currency to presentation currency, or you can even say, you can even give the heading translation of foreign operation. Even this can also be your heading, translation of foreign operation. The rates that we have selected are already given. These two figures are already given, so copy them as they are from the question. The total of our assets in $, you can see 50,000 is not multiplied by 1.13, then the figure will be higher. 50,000 is getting divided by 1.13, and then I'm getting the $, figure. I take the total of the assets, I take the total of the equity and the liabilities. Equity and liability is falling short. Difference is 24,376. This will go to foreign currency translation reserve. If you wish, below foreign currency translation reserve, you can write OCI. It is getting recognized in other comprehensive income. And in part 2, right, part 1 we are ready. In part 2 they are saying prepare a working of the cumulative balance of the foreign currency translation reserve as per the relevant Ind AS. In part 1 you are saying in your answer that 24,000, right, the balance is 24,376 in the foreign currency translation reserve. What is the source of this 24,376? Why are we getting this translation difference? See, if every asset, every liability, everything is converted at 1.13, you know, if every item is getting converted at 1.13, then there is no scope of any difference. There will be no exchange difference at all. Every asset, every liability, share capital, opening retained earnings, profit for the year, everything is getting translated at 1.13. If everything is translated at 1.13, no scope of any difference. Difference is arising because certain items are not translated at the closing rate. These are the items which are causing the difference. Just consider these items and you will get the source of your difference. If you see the question, there are 3 items which are not translated at 1.13. 3 items. Issued share capital is not getting translated. We are directly picking up the given figure. 28,000 also is not getting translated at 1.13. We are picking up the figure directly. And profit for the year is also not getting translated at 1.13. Instead, it is getting translated at the average rate. If these 3 items are also translated at 1.13, then this translation difference will disappear. Okay, it will simply vanish. Natural. Everything gets translated at 1.13. Where is the scope of any difference? So these are the 3 items which are causing the difference. These are the 3 items which are the source of foreign currency translation reserve balance. What we should do is, these 3 items we should translate at 1.13 and find out what is the amount. Compare that with what we have actually considered, and the difference is what is going to the foreign currency translation reserve. Getting it? What I am saying is something like this. For example, share capital. Think of this way. For example, share capital. Share capital is 50,000. What if I had translated at 1.13? If I had not taken the given figure, then 50,000 would be divided by 1.13 and you will get 44,248. Okay, this will be your figure in L dollar. $44,248. But the figure that we have actually considered, right, when you did translation, the figure that you have actually considered is 30,055. So this is giving me a difference of 14,193. This 14,193 is actually going to the foreign currency translation reserve. It is one of the source. Similarly for opening retained earnings, similarly for the profit for the year. Work out the difference and then take a total of the difference and you will be surprised. It is exactly equal to the balance in the foreign currency translation reserve. Here it is. The three items, as I had suggested to you, are the ones which is causing a difference over here, right? Figures are given in the foreign currency, applicable exchange rate. You will get the amount in your local currency and then what you have actually considered and the difference. Total, you can see 24,376. Here also, if you'll see 24,376. Getting it? This is what is causing the difference. And this is nothing but the source of the cumulative balance in the foreign currency translation reserve. That's the end of our answer. Yeah, whenever we are doing the translation of a foreign operation, at that time, whatever are the exchange differences that are arising, we are not recognizing that in the profit and loss account. Rather, we are recognizing it in equity. Okay, we are making it a part of other comprehensive income. And in other comprehensive income, we shall be accumulating these exchange differences in foreign currency translation reserve, or appropriately named some another reserve. The question that arises is, will this exchange difference permanently remain in OCI, or there will be a time when it shall be reclassified to profit or loss? That's what we are discussing now. Any exchange difference which has been retained, which has been accumulated in foreign currency translation reserve, it may go to the profit and loss account. It can be reclassified to the profit and loss account at the time of disposal of the foreign operation. By disposal of foreign operation, we mean there shall be either entire reduction in the ownership interest or partial reduction in ownership interest in the foreign operation. This is what can give rise to full disposal or partial disposal. Let us see, whenever there is a disposal of a foreign operation, how the treatment will be carried out of the balance lying in the foreign currency translation reserve. But first and foremost, let us understand, when can we say there is full disposal? When can we say there is a partial disposal? Okay, if you are selling away entire ownership, right, entire ownership in the foreign operation, naturally it will be considered to be full disposal. I have 100% shares in some company and I sell away all the 100% shares. I will consider this as full disposal. But, and this is important, you may sell such proportion of shares that you may lose control over the subsidiary. This will be also treated as a full disposal. Technically, it is a partial disposal, but still we will say it is full disposal. For example, you are having 100% shares in a company and you are selling away 90% of the shares. Now with 10%, you cannot control that subsidiary. I will consider this also as full disposal. Okay, you have 30% shares in an associate and you are selling away 25% shares of the associate. Now with 5% retained interest, you are not in a position to exercise significant influence. Consider this also as full disposal. Getting it? Disposal of a foreign operation, we are segregating that into full disposal and partial disposal. Entire ownership interest in the FO is standing for foreign operation is disposed of. As I said, A has 30% shares in an associate. You sell all 30%. That means entire ownership is disposed of, isn't it? Similarly, A has 100% shares in B. We sell all 100%. This is full disposal. Now that is easy to understand. Or understand, such holding is disposed of that it results into loss of control over the subsidiary. Okay, you are having 100%. If I just modify this, you are having 100% in B. We sell 80%. You are left with 20%. With 20%, you cannot control that subsidiary. Consider this also as full disposal. Okay, consider this also as full disposal. Or further they say, or retained interest after reduction in joint arrangement or associate is a financial asset. It is no longer now considered to be investment in joint arrangement. It is no longer considered to be an investment in associate. Now it is a simple investment. We know investment in equity instrument will be treated as a financial asset. So now it is only a financial asset. It is not considered to be investment in joint arrangement or investment in associate. This will also be considered to be full disposal. For example, if I modify the early one or I put a new one, let us say A has 35% shares in B. A sells 30%. You still have 5% in B, but with 5% you cannot exercise significant influence. That means B is no longer your associate. 5% retained interest is only investment in equity instrument, and investment in equity instrument will be understood as a financial asset. This will also be considered to be full disposal. Getting it? Full disposal means, very quickly, full disposal means either you are selling away entire ownership, or you are selling such proportion that you lose control over the subsidiary, or you can no longer exercise significant influence over the associate, or you can no longer jointly control a joint arrangement. All these instances will be considered to be full disposal. Certain examples are given. I believe I have already taken care of it. You are having 100% and you sell all 100%. You have 100%, you sell 80%. You have 30%, you sell all 30% or 25%. Everything will be considered to be full disposal. What is partial disposal? Okay. Partial disposal. A reduction in entity's ownership interest in foreign operation other than full or partial disposals treated as full disposals. Right, these were all partial disposals, but they are still considered to be full disposal. Anything other than this shall be considered to be a partial disposal. Consider this. Examples are given even over here also. You are having 100% of S and P sells 10%. You still have 90%. With 90%, I can still control the subsidiary. I will say this is partial disposal. You own 30% of A and now you sell 6%. You still have 24% of A, and with 24% of A, I can still exercise significant influence. Getting it? You sell such proportion of shares of a subsidiary that it still remains your subsidiary. You sell such proportion of shares of associate that it still remains your associate. You sell shares of a joint arrangement in such a way that it still remains a joint arrangement. Such kinds of instances will be understood as partial disposals. Comfortable? Full disposal, partial disposal. Okay. Now, what will be the accounting treatment of the balance which is lying in the foreign currency translation reserve? I would like to know what will be the treatment of the cumulative exchange difference on disposal of foreign operation. Again, full disposal, partial disposal. First, ask this question: is the foreign operation a subsidiary? Is the foreign operation a subsidiary? Obviously, the answer will be yes or no. Okay, understand. What we are discussing here is with respect to full disposal, and what we are discussing over here is with respect to partial disposal. Okay, ask the question. You are going for a full disposal of a subsidiary. Yes, what will you do? whatever is the parent share, understand, parent share in cumulative exchange difference recognized in OCI is reclassified to profit and loss. Parent share will be reclassified to the P&L. However, you may even have non-controlling interest. Remember, when you will do disposal of a subsidiary, the NCI will be required to be derecognized. Along with the derecognition of NCI, the cumulative balance attributable to NCI will also automatically get derecognized. In other words, the share which is belonging to the NCI is not reclassified to the profit and loss account. They say parent share in cumulative difference is reclassified to the P&L. Think in this way. P has 100% shares in S. Okay. You sell 70%. That means now you have 30% in the subsidiary. With 30%, I cannot control the subsidiary. This is full disposal. You know what you will do? Entire balance which is there in the foreign currency translation reserve will be reclassified to the P&L. Entire balance. Why? Because you have 100%. Because you have 100%, you don't have any non-controlling interest. That means whatever is the cumulative balance in the foreign currency translation reserve, entire balance is belonging to the parent. And we have already seen this. Parent share in the cumulative exchange difference will be reclassified from equity to profit or loss. Another situation is that P has 80% shares in S, right? And now P sells 70%. Okay, 10% you are still having. So with 10%, I cannot control this company, and hence I will consider this as full disposal. Whatever is the balance in the foreign currency translation reserve, 80% of the balance belongs to the parent. Parent share will be reclassified to the P&L. Originally, 20% non-controlling interest was there. This non-controlling interest will be derecognized. The moment you will derecognize the non-controlling interest, 20% share in the foreign currency translation reserve will get automatically derecognized. I don't have to do any further treatment for that. Remember, parent share is required to be reclassified to the P&L. If I have 100% shares in the subsidiary, then 100% will be reclassified to the P&L. If I have 90% in the subsidiary, 90% will be reclassified to the P&L. If I have 80% shares in the subsidiary, 80% will be reclassified to the P&L. This is how the entire classification will be carried out. Okay. That's what they say further. They say share of the non-controlling interest and cumulative exchange difference is derecognized along with the derecognition of NCI. I don't have to do any separate treatment. You will derecognize the non-controlling interest, and entire non-controlling interest will be derecognized along with the share of the non-controlling shareholders in the foreign currency translation reserve. If it is not a subsidiary, okay, if it is not a subsidiary, then it is simple. Cumulative exchange difference recognized in OCI is reclassified to profit and loss. Whatever balance is there, let it go to the P&L. Some examples are given, and I am sure that will make things very clear. Just see, P owns 100% of S. That means non-controlling interest is 0%. In this situation, do not worry about the NCI. P is selling 70%. You are still retaining 30%, but you have lost control over the subsidiary. This is full disposal. Okay, parent share is to be credited to the P&L, or I'll rather say reclassified to P&L. Parent share. What is parent share? You are owning 100%. Hence, 100% will be transferred. 100% of the foreign currency translation reserve will be transferred or will be reclassified to profit and loss account. Just see, entire balance in FCTR. I have clarified over here. FCTR is standing for foreign currency translation reserve, is reclassified to profit or loss. Comfortable? See the next one. P owns 90%. Understand, P owns 90%. That means non-controlling interest is 10%. Okay, P sells all 90%. Understand, the moment you are selling away all 90%, you can no longer control the subsidiary. That means this is also full disposal. Parent share is to be reclassified to P&L. What is parent share? 90%. Earlier, parent share was turning out to be 100%. This time, parent share is 90%. 90% of the balance in the foreign currency translation reserve will be reclassified to the P&L. What about the remaining 10%? Non-controlling interest will be derecognized. Along with its derecognition, their share of 10% will also get derecognized. In other words, the share that belongs to the non-controlling interest is not reclassified to the P&L. Okay. 90% of balance in the foreign currency translation reserve is reclassified to the P&L. NCI will be derecognized along with the 10% balance. And here they are saying P owns 30% of A. P sells all 30% or 25%. Doesn't matter. You sell all 30% or 25%. Whatever is the balance in, right? They are saying entire balance in foreign currency translation reserve is reclassified to profit or loss. Getting it? Whatever is your share. Basically, when you have an associate or when you have a joint venture, you will be recognizing in your books only your share in the foreign currency translation reserve. Hence, whatever share you have recognized, let it go to the P&L. Just reclassify that to the P&L. What in case of partial disposal? Okay, partial disposal, that will be simple. Proportionate share in cumulative exchange difference recognized in OCI is reattributed to NCI. Very typical. When you will do a partial disposal, it will actually give rise to NCI or the NCI will increase. Okay. Whatever is the balance that belongs to the NCI should be made a part of the non-controlling interest. There is no question of reclassifying anything to the profit or loss. While here, proportionate share in cumulative exchange difference recognized in OCI will be reclassified to profit and loss. This time, proportionately, it will go to the P&L. These examples will make things much clearer to us, right? They say P owns 100% of S. Okay, P is having 100% of S and now P sells 10%. Originally, non-controlling interest was 0%. Okay, there was no non-controlling interest as well. Now you are selling 10%. That means you have 90%. With 90%, you can still control the entity. This means 10% is now becoming a non-controlling interest. Earlier, whatever balance was there in foreign currency translation reserve, 100% was belonging to the parent. Now 90% will belong to the parent and 10% will become a part of the non-controlling interest. Non-controlling shareholders will also share in the foreign currency translation reserve. After all, it is a part of equity. Non-controlling interest is nothing but part of your equity ownership. And hence they will also get 10% share in the foreign currency translation reserve. P owns 40% of A. P has 40% of A. And now P sells 5%. That means you have 35%. With 35%, you still have significant influence. That means this entity is still your associate. But 5% has been sold by us. Hence, 5 will be divided by 40 to express in percentage. Proportionate share is 12.5%. 12.5% of the balance lying in the foreign currency translation reserve will be reclassified to profit or loss. As you can see, 5 by 40, that is 12.5% of the balance in the foreign currency translation reserve is reclassified to profit or loss. Very quickly, if we can just run through this. Whenever there is full disposal or partial disposal, ask yourself, is the foreign operation a subsidiary? If the answer is yes, if you are doing full disposal, whatever is the parent share in the foreign currency translation reserve, reclassify that to the profit or loss. Whatever is the share of the non-controlling interest will get automatically derecognized along with the derecognition of NCI. If your foreign operation is not a subsidiary, then whatever is the balance, right? Whatever is the balance, entire balance in the foreign currency translation reserve shall be reclassified to the P&L. If it is a partial disposal, okay, ask again yourself, is this foreign operation a subsidiary? Yes. Then whatever is the proportionate share which belongs to the non-controlling interest should be made a part of NCI. In other words, there is no question of any reclassification from OCI to the P&L. But if your foreign operation is not a subsidiary means it can be an associate, it can be a joint arrangement, it can be a branch. In that particular situation, whatever is the proportionate share that you have disposed of, to that extent, whatever is the balance in the foreign currency translation reserve, to that proportionate extent, it should be reclassified to profit or loss. Parent P acquired 90% of subsidiary S some years ago. P now sells its entire investment in S for rupees 1500 lakhs. The net assets of S are 1000 lakhs and the non-controlling interest in S is rupees 100 lakhs. The cumulative exchange difference that have arisen during P's ownership are gains of 200 lakhs, resulting in P's foreign currency translation reserve in respect of S having a credit balance of rupees 180 lakhs, while the cumulative amount of exchange differences that have been attributed to the non-controlling interest is 20 lakhs. Calculate P's gain on disposal in consolidated financial statements. You are having 90% in S, which was acquired some years ago. Fine. P is now selling entire investment. P sells all 90%. This is disposal of subsidiary. Okay, this is disposal of subsidiary. Not only that, it is also disposal of foreign operation. Disposal of subsidiary is something that is covered by Ind AS 110. While disposal of foreign operation, that is something covered by Ind AS 21. Okay, because they are saying cumulative exchange differences have arisen, that is making it very clear that this subsidiary is a foreign operation. If it is an Indian operation, then there is no question of any exchange differences. Hence, 2 Ind AS is getting applied over here simultaneously. Ind AS 110 will treat this as disposal of subsidiary, and when there is a disposal of subsidiary, there is a typical way in which gain on subsidiary is to be calculated. Gain or loss on disposal of subsidiary is to be calculated, but that will be done as per Ind AS 110. What will be the treatment of the balance lying in the foreign currency translation reserve? That is a subject matter of Ind AS 21. Now, because you are selling away all 90% shares, you are now no longer in a position to control this subsidiary. And that is the reason we will say this is full disposal. In case of full disposal, the parent share in the balance in the foreign currency translation reserve will be reclassified to the P&L. Okay. Total exchange difference is 200 lakhs. Okay, total is 200 lakhs. And with respect to parent, it is 180 lakhs, 200 into 90%, and 10% of 200, that is 20 lakhs, is attributable to the non-controlling interest. Parent share will be reclassified to the P&L. In other words, 180 lakhs, right? This 180 lakhs that you have, this will be reclassified to profit and loss. This will happen as per Ind AS 21. Okay. What about this 20 lakhs, which is belonging to the NCI? Okay, non-controlling interest is derecognized along with this 20 lakhs, right? I will derecognize the non-controlling interest. This derecognition is happening as per Ind AS 110. However, the question is not that how the foreign currency translation reserve should be treated. No. Question is, calculate P's gain on disposal in consolidated financial statements. This is not done as per Ind AS 21. This will be done as per Ind AS 110. I will apply Ind AS 110 over here, right? I'll apply Ind AS 110 over here, and applying the methodology given in Ind AS 110, I will determine whether the gain on disposal or whether there is loss on disposal. We will apply Ind AS 110 and calculate the same. Okay. How shall we do it under Ind AS 110? Very simple, actually, very simple. I'm not too sure whether you still remember it or not, but yes. First of all, we should take the sale proceeds. You are selling away 90% of the shares. So what is the sale proceeds? They have given that the sale proceeds are 1500 lakhs. Okay, 1500 lakhs. These sale proceeds should be compared with the net assets disposed of. This I will compare with net assets disposed of. Okay, right. Now, net assets they have given as 1000 lakhs. But you are not going to dispose of 1000 lakhs of the net assets of the subsidiary. You are having 90%. Remember, you are having 90%. Your sale proceeds is for 90% of the shares. Hence, the net assets disposed of should also be 90%. Okay. Total net assets are given as 1000. It's 90%. That is turning out to be 900. Intermittently, I am getting 600 over here. Getting it? You are selling away 90% of the shares for 1500. The moment you are selling 90% of the shares, you are giving up 90% of the net assets of that company. Hence, 90% of the net assets are deducted. This leaves me with 600. Okay. Now, foreign currency translation reserve will be reclassified to the P&L to the extent of your share. So now I will say over here, our share in balance in foreign currency translation reserve reclassified to profit and loss. I will reclassify 180. This gives me 780. If you are asking me what is the gain on disposal, gain on disposal is 780 lakhs. Getting it? 780 lakhs is the gain on disposal. 10% is representing non-controlling interest. Please understand, the moment you will sell away all 90% shares, this company is no longer your subsidiary. If it is no longer my subsidiary, where is the question of showing non-controlling interest? Hence, non-controlling interest is getting derecognized. Along with the derecognition of the non-controlling interest, the share of 10% that was belonging to the NCI is automatically taken care of. I do not have to give any separate treatment for that balance 10% in the foreign currency translation reserve. Right. Here it is. Sale proceeds 1500, net assets disposed of 900, intermittent 600. And parent share in cumulative exchange difference recognized in foreign currency translation reserve reclassified to the P&L. 600 will go to the P&L, 180 will go to the P&L. Total gain on disposal is 780. This is what is going to be recognized in the consolidated profit and loss account. Share of the non-controlling interest and cumulative exchange difference of 20 lakhs is derecognized along with the derecognition of the non-controlling interest. I hope you are comfortable with the answer. You can also, I will even advise you that you can also go through our notes on Ind AS 110 with respect to disposal of subsidiary. When you will see this solution along with what we had done at that point of time, yes, it will become that much more clearer. In consolidated financial statements, Ind AS 110, we had a section of disposal of subsidiary. Just go through that section and revise this question along with it. Okay, because at that time we had discussed at great length the disposal of subsidiary, and this question will become very clear at that particular juncture. The end of our